here in New York City. I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for their portfolio. We're tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
Happy Thursday or Friday's Eve to everybody who celebrates out there. Stocks hitting record highs after the Federal Reserve reaffirmed its projection of 3 interest rate cuts this year.
And it is a huge day for the IPO market, really more broadly speaking, for the market. Reddit making its public debut on the New York Stock Exchange later today, the first social media company to go public in 5 years. We've got team coverage for you from the floor of the New York Stock Exchange, and we will be hearing from Reddit CEO Steve Huffman right after that first trade. So let's get right to it. The 3 things that you need to know, your roadmap for the trading day. Yahoo Finance's Jared Blickery, Josh Schaefer, and Ines Ferre have more.
Stocks are rallying to record highs on Wednesday after the Federal Reserve kept interest rates unchanged in March and stuck to its forecast of 3 rate cuts later this year. Fed officials see the Fed funds rate peaking at 4.6% in 2024. That suggests the Fed will cut rates by 75 basis points. Updated projections suggest the Fed is going to maintain a higher for longer policy stance as the central bank works to bring inflation back down to its 2% target.
And Reddit is ready to take on the stock market. The social media platform will make its big debut on the New York Stock Exchange today. Reddit pricing its IPO at $34 per share. That's at the high end of its target range.
And Bitcoin reversing some of its losses from a recent slump. The world's largest cryptocurrency hovering around $67,000 after Bitcoin spot ETF in the U.S. recorded 3 straight days of outflows, $261 million leaving the 10 approved funds as of Wednesday.
Good morning, everyone. Not too many surprises from the Federal Reserve at Wednesday's meeting. In the conclusion there, the FOMC holding rates steady once again and maintaining its forecast to cut rates 3 times this year. Of course, inflation has remained sticky to start 2024, causing Fed officials to raise their core PCE inflation outlook for the year to 2.6% from 2.4%. Here's what Fed Chair Jay Powell had to say about the path towards lowering inflation at Wednesday's presser.
We're strongly committed to bringing inflation down to 2% over time. That is our goal, and we will achieve that goal. Markets believe we will achieve that goal, and they should believe that, because that's what will happen over time. But we stress over time, and so I think we're making projections that do show that happening, and we're committed to that outcome, and we will bring it about.
Joining us now to discuss further, we've got Satya Pandey, who is the S&P Global Ratings Chief U.S. Economist, and Vishal Khanduja, who is the Morgan Stanley Investment Management Co-Head of Broad Markets Fixed Income. Great to have you both here with us this morning. Satya, I'll begin with you. As we think about what we heard from the Fed just yesterday and Fed Chair Jay Powell in that presser, I mean, how much of a significant move is this, given that we were all tracking the dot plot going into this meeting? We got a little bit more context about the rate and the pacing of cuts, too, here.
Yeah, well, they did reveal their preference to be patient with inflation. So the dot plot by itself did not really show much of a move for this year, but it did move the 2025 rate cuts assessment that they have in their minds. It seems like at least 75 basis points for this year and another 75 basis points for next year, which means they actually pared back some of the rate cuts for 2025, about 50 basis points or so. So they will be patient with inflation. And, to be honest, they do have this optionality right now to wait it out and see, especially given the resilience in the economy.
Vishal, when you take into account the reaction that we saw within the market yesterday, we had the equity market rallying to record highs. We saw some pressure on yields here on the heels of this announcement and the presser that we got here from Jay Powell this morning. Does that market reaction, does that make sense?
Oh, very directly. Thanks again for having me on. Good morning. I heard your initial comments as just prior to this segment very clearly. I think they've lowered the bar on data. What do I mean by that? They've acknowledged that the economy is running slightly hotter than what their expectations were as well coming into December, meaning growth is slightly going to be higher. Inflation is going to be higher. And even then, they've maintained their 75 basis points. And not only that, but they've also probably had slightly more confidence, more dots in that 3 cuts in 2024. And yes, as Satya mentioned, slightly lower longer-term neutral rates. So what does that do? It gets into steeper curves, dollar slightly being weaker, and risk assets, again, getting a bid back where the hesitancy of bid was there earlier this week as central banks dominated the flow this week.
And Vishal, what does that do to the attractiveness of fixed income right now?
Very attractive from our point of view. Again, we might be a little biased in our vantage point. We are active fixed income managers here, but our franchise flows and also the industry flows that we track very clearly. We feel that, or we believe that, November and December was just a glimpse of how a significant hoarding of cash or money markets that has gone on since 2022. And when that starts moving out the curve as, clients lock in some of those yields, as the Federal Reserve gives them the confidence that we are down, or our next move is going to be a down in interest rates rather than up in interest rates. So that definitely bodes really well for short and intermediate term fixed income instruments, even though the curve is slightly inverted, especially in the front end.
Satyam, Jay Powell said what the markets really wanted to hear, also from the economist perspective, too, just in terms of those expectations that the economy is going to hold up even better than the central bank initially thought. What, though, does that last mile fight to tame inflation, what is that going to look like, and why is it so difficult at this point?
Well, I think it is going to be bumpy, and when you just look at the core goods, the core services, and the core, once you take out the shelter from the core services, just the combination of those three is what is going to make the path of inflation moving forward. We think that, just like, Chair Powell said, the shelter component is going to reassert itself in the aggregate number. It's the core, once you take out the shelter, that actually goes more closely with the labor market strength. And that we have seen some wage numbers starting to become less of the strength that it showed last year. So I think that should show up in the data moving forward. Again, having said that, it is going to be tricky. The timing is such that I think the risk may be that it may be delayed earlier than what we think right now. June, July is what everybody thinks, but it may be that it have to be pushed back a little bit.
How far?
Well, I wouldn't say how far, but there is a risk that inflation may be a little bit more stickier than what many have been thinking right now. I mean, we've already seen, January and February sort of surprise us. There may be more surprises, right? But still, fundamentally, we think that it is on its downward path towards 2%, but it's just how fast is it going to get there to be comfortable for them to start cutting rates?
What would that pertain for the balance sheet runoff as well, then?
Well, the balance sheet runoff, it's in a different channel right now. What Chairman Powell basically said, they are going to fairly soon come out with something. I think it may be May is when they will announce, and maybe perhaps the balance sheet runoff will be slowed down beginning in June. So that is a net positive for financial conditions in general. But again, the idea here is to let the balance sheet runoff last longer, and maybe we will get to a point where the balance sheet itself of the Fed is actually smaller than what would have otherwise been, and avoid some hiccups down the way. Like, back in 2019, we did have a hiccup in September, which they really want to avoid that. So,
Vishal, just lastly, while we have you, certain corporate sector bonds here, you are also liking those. Which corporate sectors, most notably, should investors perhaps be considering for their portfolio?
Financials in the investment grade corporate land, I think we've issued about 500 billion of new issues in the first 2.5 months here, or 2.5 months here of the year. Financials, and especially the money center banks here in the U.S., have pretty fantastic, fundamentally strong balance sheets, and valuations there are still attractive, whether you look at it from a fundamental basis and adjusted for the rating that those banks are at. Also looking at it from a longer-term perspective, where value lies within the fixed income market. So financials within, especially the money center banks or the GSIBs, are a great spot to be in the investment grade corporate line.
All right, Satyam and Vishal, thank you both so much for joining us here this morning to take a little bit of a deeper dive into what we heard from Fed Chair Jay Powell yesterday. All right, well, the other big story in the market here this morning, it's going to be a huge test for the market and the IPO market. Reddit making its public debut on the New York Stock Exchange. Investors, well, they're on the edge of their seats. It's the first big social media IPO since 2019. Later on this morning, we are going to be hearing from Reddit CEO Steve Huffman. He will join us right after that first trade live from the floor of the New York Stock Exchange. But right now, we've got team coverage for you on this story this morning. Our very own Josh Schaefer and Ines Ferre are covering the public debut here for us. Ines, I know you're closely following where it priced last night, what that could indicate in terms of the opening here this morning. What are you seeing?
Yeah, so they priced their shares at the high end of the expected range at $34 a share. That range was between $31 and $34. So they raised $748 million. This values the company at around $6.4 billion, down from that private round funding back in 2021, where the value was around $10 billion. But look, revenue last year, that increased about 21% year over year to hit $804 million. Their net loss, it is not profitable yet. Their net loss is at $90.8 million. That's narrower than the prior year. I will note that advertising is the majority of their revenue, and they stated that numerous times throughout their S1 filing. But they say advertising is rapidly evolving. They're in their early phases of growing this business, even though the company has been around for about 19 years, and that they're trying to develop ways for Redditors to make money on the platform, for users to be creating avatars, for content that will generate revenue in some way for Redditors.
Yeah, absolutely. We know that, and as you bring up the profitability aspect of this, they had $716.6 million in debt, accumulated deficit rather, coming into the start of this year. Josh, you're focused in on the AI piece of this, though, and that's something that the company also talked about.
That saves all profitability problems, Brad.
Of course.
Yeah. They're hoping that. They're banking on it.
If you have AI, it's fine, right? Yeah. It doesn't matter.
Yep.
But in all seriousness, it is interesting to see sort of the AI pitch that Reddit is building here. It's something that they think is going to be a different source of revenue. And Ness had pointed out that 98% of their revenue right now comes from ads. This is sort of their pitch to investors that they can build out a different model and be a real AI company, given their database, given how big it is. But it's something that when I was talking to IPO experts, they think that this is just a little bit of the pitch of the moment right now, too. Mm-hmm. And this is something that you are going to see a lot of companies do. I was interested, Jay Ritter, a professor at University of Florida that studies IPOs, he actually told me directly, he said one private company that's going through fundraising right now had their financial advisor tell them, you've got to have AI in your business plan. That's what investors want to hear right now. If you don't have it, it's going to make it much harder for you to raise funds. That's very interesting to hear an advisor telling a private company that basically you got to find some way to put it in here.
Yeah.
You have to have how you're using this technology
also,
in there.
You don't even have to look any further than what happened with Astera Labs yesterday, right? We saw a massive spike in their first day of public trading. Obviously, the AI tie there, but investors can't seem to get enough of it. And it's also very similar to what we've heard on earnings calls, too. Just in terms of so many executives, it seemed like at least, felt the need to mention AI in order to reassure any sort of doubt out there that they have some initiative, that they're thinking about it, that they are going to or plan to incorporate it into their business model. Whether or not it's going to be really able to change or help the fundamentals of Reddit's business, that's still very much a show me story.
Yeah, and they do talk about data licensing. They mentioned that quite a bit throughout the S1 filing. I mean, they're basically saying we can help with our data with these machine language learning programs for AI, and that they can license their data. The question is, how are they going to negotiate that with the privacy of their users? And once you're a public company, you have to expose a lot about your company and how you're generating revenue. So this is going to be interesting for them, how they do that.
Well, and I was just going to say what that means for the stock, right? And sort of when we think about what that means for the IPO market here, one thing that Ines highlighted that we didn't harp too much on is the valuation coming down significantly. Mm-hmm. And that is why a lot of companies are not coming public right now. People in the IPO market are talking a lot about that. Reddit essentially taking what you could call a down round right now, coming to market at 6.4 billion or 6.5 versus 10. Same thing happened with ARM Holdings. Same thing happened with Instacart. A lot of these companies, they had higher valuations at their last funding round, and that's part of why you're seeing this backlog in the IPO market. Maybe if the stock reaction is positive, that sort of helps loosen you up a little bit and give people a little bit more confidence.
Well, do you want to see a massive stock reaction on the first day, especially if that implies that you left money on the table in the deal as well here? And on your point, Inez, the company did have to point out in that S1 filing, our massive corpus of conversational data and then additionally knowledge is what makes us unique. We believe that its value will continue to grow over time as user-generated data continues to grow. It's a matter of how comfortable those users are knowing that it's going to be aggregated into some of those language learning models as well here. Inez and Josh, thank you so much for teeing up what we're going to be watching here today as Reddit goes public. We're going to hear from our very own Brian Sazia along the way as well, live from the New York Stock Exchange at 11 a.m. Eastern Time. He's got the Reddit CEO, Steve Huffman. You do not want to miss that. Well, shifting gears here, our stock to watch today is Micron. It's the #1 trending ticker on Yahoo Finance's site pre-market. Shares of the chip manufacturer skyrocketing after beating on the top and bottom line in the company's second quarter. Micron posting better than expected guidance for the third quarter, driven by demand for, you guessed it, AI hardware here. And so as you're taking a look at the actuals versus the estimates, it was expected that this company would report a loss. They did not. They reported a gain. In fact, adjusted EPS coming in at 42 cents when the street was looking for a loss of about 24 cents a share. And then revenue, that clearly beating on expectations as well here. You got a dozen actually, firms that raised their price target after this bang-up report here from Micron, which looked at some of the AI demand-driven components for their business as well, accelerating.
Yeah, certainly. We will be speaking with one of the analysts who did up his price target from TD Cowen later on in the show, just getting his thoughts on this recent results here from Micron. But once again, this reaffirms the fact that at least for semiconductors right now, many of those chip makers, they seem to be on this road to recovery. They are starting to see demand. They are starting to get a better hold of those inventory levels. Now, the plan here from Micron to boost CapEx in fiscal year 2025, that's helping some of the competitors out there. I mean, we are seeing an upside reaction from Applied Materials, from Lam Research. So that's helping to reassure the street at this point as well. You mentioned the fact that so many of these analysts raise their price targets on the stock. Some quick reaction here. KeyBank saying that the pricing uptrend and also normalizing business operations is expected to sustain that margin recovery story into fiscal year 2025. And also Morgan Stanley saying that it was a good quarter from Micron, but the bigger surprise was management's continued visibility and enthusiasm. So pointing to that recovery, pointing to the fact that they expect to see the increase of demand carry into the new fiscal year. What that could do for the stock, a lot of analysts, at least right now, making the argument that they still see room to run to the upside.
Yeah, and expecting on top of that, being able to put more price into the market. They expect DRAM and NAND pricing levels to increase further throughout the calendar year 2024 and expect record revenue and much improved profitability now in the fiscal year of 2025 because of the demand combined with the pricing that they can put out there to many of those customers. And I was looking for a reason to talk about nodes again this week, which I got more of a definition from one of our viewers who actually tagged us and responded after we had our amazing conversation earlier this week trying to break down node demand and how it refers to the minimum transistor geometry there. So we'll go further in on that on another day.
I was going to say, you're going to have to break that down a little bit more.
Maybe.
All right. Let's take a look at gold and what's also being dubbed digital gold on the move. Now, gold is trading at all-time highs, breaking above $2,200 and troy ounce level on dovish comments from the Fed, so reaching an all-time high. Also, Bitcoin on the rebound this morning. It's back above 67,000. Inez Ferre is over at the big board with a closer look at the pricing action that we've seen. Inez.
Yeah, Shauna, take a look at Bitcoin right now, as you just mentioned, up 6%. This is over the last 24 hours because remember that Bitcoin trades 7 days, 24/7. So we are seeing the price action here moving higher. But over a 7-day chart, you can see where you saw Bitcoin basically tumbling down to below around $62,000 per token in the last several sessions. And part of that had also to do do with outflows from those spot Bitcoin ETFs, Grayscale being one of them that saw most of the outflows, but nevertheless, outflows from those for 3 days in a row from those spot ETFs. Ethereum also, I want to mention, up around 3,500 per token. Moving on to gold. Gold touching new highs after those Fed comments from yesterday, where we're looking at gold futures at 2,000, just above 2,200 per ounce. Now, adjusted for inflation, gold had a high back in 1980, but nonetheless, this is a big run-up for gold, as we're seeing, because the market is anticipating Fed cuts later this year. So yesterday's comments from Fed Chair Jerome Powell basically indicating that there will be cuts coming. That is sending gold higher, guys.
All right, Ines, thanks so much for breaking that down for us. Coming up, far from over here, we also have Paramount reportedly getting a bid for its film and TV studio. We are going to break down the market reaction and also what that tells us more broadly about the streaming space just ahead. We're also tracking the public debut of social media platform Reddit that is set to start trading later on this morning under the ticker symbol RDDT. We will hear from Reddit CEO Steve Huffman right after that first trade from the floor of the New York Stock Exchange. More from Yahoo Finance ahead.
Apple is under antitrust scrutiny yet again, this time reportedly by the Department of Justice. Bloomberg reporting that the DOJ is expected to sue the tech company as soon as Thursday for alleged antitrust violations. Let's bring in Yahoo Finance's Alexis Keenan to bring us the details here. Hey, Alexis.
Hi, yes. So we've been talking about this investigation for 5 years. This goes all the way back to the Trump administration. So not new, but we continuously get reports that we're on the precipice of this lawsuit coming out. So that could be today. And what was reported in January by the New York Times is that the scope of this antitrust probe and potential lawsuit by the DOJ against Apple is really broad, going after its whole ecosystem. So you think about iPhones, App Store, iWatch, iMessage, and all of those things that the company tries to tie together in what some people call its walled garden. Now, the Bloomberg report that came out last night, they say the focus is on the iPhone hardware and software. So narrowing it a bit, but still, when you lump hardware and software together, that's still pretty broad, right? But we don't know what is in this lawsuit, if it is in fact going to be filed. So we have to wait and see. Now, this DOJ suit, if it happens, it would be the third time that the department has brought antitrust claims against Apple. These do sound, though, like they would be the broadest to date. But you have to go back also and look at the fact that the DOJ also joined in a private antitrust suit back that Epic Games brought, that very high-profile one that they brought targeting the App Store and the way that Apple charges fees to push developers. So the only way that anybody can buy anything in the App Store is to get that fee that Apple charges lumped down, that 30%. Now, in that suit, the DOJ came in and they joined it, not for exactly the same reasons as Epic was in the suit, but they were in play there. So they have been involved in antitrust allegations, concerns with Apple. But all the target so far has been on the App Store. You also had the EU recently, a $2 billion fine against Apple for the way that the EU says it broke the law there by excluding other music apps from the App Store. Also, you had Apple really mostly winning that Epic case in the US, but being forced to let app developers put in another way for payments to be made, right? You had to be able to tell your customers that they can go ahead and make a payment outside of the App Store. But now, layered on top of that, you have a bunch of big tech companies wanting in on that revenue. They had joined a filing in federal court that Epic has complained about how Apple is implementing this court order where they're having to open up the system. Meta, Microsoft, X, Match Group, all joining Epic and saying, we want Apple to change because what Apple did in order to say they're complying with that lawsuit in the US is to slap on a 27% fee for those app purchases that are made outside the App Store. So a lot at play here. We're going to be looking for this lawsuit. We'll tell you more if it's happened. We'll get into the nitty-gritty details, but this is what we know as of right now.
It could happen any minute today. All right, Alexis Keenan, great stuff. Thanks so much for breaking that down for us. Let's get to another trending ticker here at Yahoo Finance, and that is Paramount Global, reportedly receiving an $11 billion bid from PE firm Apollo to buy its film and TV studio business. This is according to a report from the Wall Street Journal. We also want to note that Apollo is the parent company of Yahoo Finance, and Apollo did not respond to Yahoo Finance's request for comment. Paramount said that it had no comment on this report. Now, Brad, this is just a follow-up of earlier reporting that when we brought to our viewers' attention that Apollo could potentially be interested in Paramount. We know Paramount has been struggling just a bit just in terms of gaining more traction, being able to compete with some of the larger media players within this space. There has been a long time rumors of possible M&A activity within the sector, Paramount being one of the names that has been tossed around a little bit. So this would be an interesting move here from Apollo, if in fact Apollo does make or is making that bid, like the Journal report says, $11 billion for Paramount's film and TV studio.
Yeah, it's really interesting here. And the studio business has really been one of the biggest elements that's really driving some of the bids that have come forward for Paramount here. They've also got a considerable effort, though, in the turnaround side on the TV networks. Cable business contracts particularly coming in focus there. And so that's perhaps one of the larger overhangs or concerns that could depress at least the deal size, but at the same time, this offer is slapping a pretty good premium on the market cap right now for Paramount. So that is something for investors to try and price in ahead of any potential pen going to paper here on this deal or DocuSign.
Yeah, and there's also an FT report I'm reading right now here. FT report saying that Redstone is unconvinced by Apollo's offer for the studio and is instead negotiating a rival deal with billionaire David Ellison. That's according to sources here from the Financial Times, from the FT. So again, a story we are going to continue to follow. Paramount, at least in the pre-market action, off just about 0.1%. You're counting down to the opening bell on Wall Street. And Brad, it could be another record-setting day for the markets when you take a look at futures and where it looks like we are going to open the day. Once again, to the upside, coming off of yesterday's record close. You've got the S&P. We could open above 5,300. The Dow looks like it could add over 100 points here at the open. So really pointing to the fact that the market, at least for now, heard what it wanted to hear from Fed Chair Jay Powell. No real surprises in terms of those economic projections. The fact that the Fed still likely sees 3 cuts before the end of the year, reassuring some of the skeptics out there.
Here's something interesting for you, and we don't see this all the time. You know what the number 2 trending ticker on the Yahoo Finance platform is right now?
What?
It's Reddit. The company hasn't even gone public yet. There's a ton of demand, at least perhaps from some retail investors out there that are trying to look at least the ticker page right now just to see when it begins trading. Here, I got some info for you folks. That trading window, even the book building process, probably not going to happen until the 10 a.m. hour. So that is something to keep your eyes on, and then we'll get some indication of where the pricing may eventually open up on that first trade. We'll have our own Brian Sozzi down there for you. Wow, nobody up on the podium. Just the info. What do you even call the Reddit?
Mascot.
Icon, the mascot. I mean, Snapchat has the Ghostface Chiller. Facebook or Meta Platforms has a Infinity. I don't know how you kind of personify that into a mascot. They better call Philadelphia because they've got some creative ones. The Philly Fanatic and Gritty included, of course. And then a hip-hop rabbit that we had for the Sixers for so long. Anyway, that's Reddit ringing the opening bell at the New York Stock Exchange ahead of its first trade. And then in Midtown Manhattan at the Nasdaq, you got, I didn't catch their company logo, so you got a great company, great folks over there ringing the opening bell. A little bit of funfetti here on the day. All right, that's the opening bell. Take a look at the major averages as we begin today's trading activity. Green across the screen. Yahoo Finance's Jared Blickery back live in living color at the Interactive. A record-breaking week for all 3 major averages, Jared, after the Fed reiterated its plans for 3 rate cuts this year. What are you seeing?
You bet. And some interesting sector movements as well with respect to records. So I'll get to that in a second. First, want to point out the action today. We're seeing tech in the forefront. That is up about 0.9%, followed by consumer discretionary and communication services. Those are the 3 mega cap sectors. Those are outperforming. So we'll take a look at the Nasdaq 100 in a second. Staples and energy, the 2 sectors trading to the downside. And let's see if it's all going to be about the mega caps today. We have Apple down about 1%. That's kind of been the story this year, a bit of a disappointment. But now we see some other movement. Meta up over 1%, Nvidia up over 2%, trying to get a record high again after a few weeks. Tesla up over 1%, and Broadcom, which has surpassed Tesla in market cap, that is up over 4%. Just an incredible run for Broadcom there. And let's take a look at our leaders. We've seen crypto leading quite a bit of the time, but not today. We see the chip stock, SOX in the lead. That's up 3%. So we'll take a look at that in a second. Then GBTC, that's my Bitcoin proxy. So Bitcoin doing well in there. Really not a whole lot of red. You take a look down there, really just Chinese stocks. That's down about 0.5%. And got to take a look at, if we can real quick, take a look at gold because we saw gold have one of its best days in months yesterday. Let's see, we're seeing it down fractionally, just fractionally today, but you take a look at the 1 year, you can really see how it kind of popped up and perked up recently, but that's feeder cattle. But I can tell you that gold in a similar pattern there, recently breaking to the upside.
All right, Jared, thanks so much. Now, just to clarify, if there's any questions out there, Jared, I don't know, you might have already known this because I feel like you know it all when it comes to the market, but the Reddit mascot, his name is Snoo.
Snoo?
General
I like
Snoo.
that.
Like Snooki?
You know, it reminds me of Snap because that's another social media IPO. I was down there in 2017 at the time. Took forever to open, 12:30, 1 p.m. Hopefully not a repeat today.
Hopefully not. We will see. We will, of course, track any of the action here once the order books open, which we're expecting, like Brad said, right around the top of the 10 a.m. hour?
Yeah, sometime around then you'll start to see that indication price moving.
All right, we'll keep right here on Yahoo Finance. We've got much more of your market action ahead. We'll be right back. All right, well, stocks rallying to record highs after the Federal Reserve maintained its outlook for 3 rate cuts this year. The S&P opening above 5,200, pushing even closer and closer to that 5,300 level. You've got the Dow up nearly 200 points here at the open. Keith Lerner of Truist, Co-Chief Investment Officer, joining us now. Keith, it's great to see you here. So I guess first, just your reaction here, this March that we continue to see 2 record highs, this March to the upside, anything going to stop the market's momentum anytime soon?
Yeah, well, great to be back with you, Shawna and Brad. I wish I was in studio with you all, but this is a good second. Listen, I think what we're seeing is we're in a bull market. Bull market rules apply, and what tends to happen in a bull market is the surprises tend to be the upside. I mean, of course, there's going to be something at some point that we're going to have a gut check. I mean, we've only had like 1 or 2 days of that. If you go back the last 30 or 40 years, it's very unusual not to have at least, at some point, a 5% correction. But I think more importantly, as an investor, you want to stick with the primary trend. That primary trend is positive, and it's being supported by fundamentals as well. The forward earning estimates for the S&P just made another record high, and that's been happening almost every week as well. So I think the bottom line is that the primary trend is positive. If you do have pullbacks, which we will have, use those as an opportunity, but it's not a place, even if we get a little bit extended on a short-term basis, that we would be selling into.
Keith, there are probably a lot of investors out there that might be wondering where a safe place to invest in the market is when the market is already at record highs. Do they just go and pile into the crowded trade, or are there other areas that are catching your eye right now?
Yeah, well, the first thing I will just say is that new highs make investors nervous. But new highs are not a bad thing. When we look back historically, when you make new highs, the forward returns are actually positive. And the other thing we have to kind of keep in context here is the market didn't do anything for 2 years, right? It went down in 2022, up in 2023, but over that period, you were flat. Our work suggests after you're flat for 2 years and you break out, the probability of positive returns is well above average. Now, going back to your specific point on areas, I mean, we still like tech, we still like communications, we like financials, which are at a new high, but still well below where they were several years ago. So there are pockets of opportunity. The equal-weighted S&P also just broke out to a new high, but didn't do anything for a few years. Also, we're neutral small caps, but I will say that is a cheap area of the market that you could also see some catch up there as well. So I still think there's plenty of opportunities in the overall market right now.
Keith, are you a little bit more bullish on small caps after what we heard from Powell yesterday and what was included in the summary of economic projections, just in terms of GDP holding up even better than initially thought?
Yeah, listen, I want to be, because they're really cheap. The one thing that we've noticed in our work and what we're waiting for some confirmation is, I talked about those forward earning estimates for the broad-based market moving up. We're not seeing that same trend for small caps or mid caps. They're weaker. So I'd like to see that move up. But strictly from a valuation standpoint, if the yields come down, you'd probably get a bigger rip in small caps. So I think the way I would say is we're sticking with large caps. But for those that are underweight small caps, I think, to your point, if yields come down further, that would be a positive for small caps. Because they have so much floating rate debt, they're more sensitive to interest rates. So I do think there's an opportunity there.
Keith, according to some FactSet data, over the quarter in the earnings period and season, I should say, we're at the second highest level of mentions of AI on earnings calls here. What does that signal to you about where investors should be considering or thinking about what's actually going to play out after this hype phase, and many of these companies have to deliver on that through their earnings?
Well, I think when you start to see, companies that only have small exposure to AI, no exposure, and they start talking about it, you have to raise your antenna a bit, saying, hey, there's some speculative parts. People are getting really positive today because the market's at an all-time high. So you just have to be mindful. I mean, we remember back in the late 90s that we would start seeing something similar about .com. Companies would change their names to have a .com. So I think that's something to keep in mind. More broadly, though, Brad, I will say, when we just look back more recently at tech's recent outperformance is a little bit over 30% over the last 3 years relative to the S&P. You go back to the peak in 2000, tech's outperformance was 250%. So again, 250% versus 30. We're not seeing a broad-based bubble, but we're certainly seeing pockets of speculation that I think investors just have to be mindful that things don't go straight up, and those more speculative areas obviously have more risk.
Keith, how are you looking at an IPO like Reddit? Not specifically the company, but what that could signal just in terms of renewed interest in certain areas of the market?
Well, I think it would be healthy. We're not, as much as the market's up, I mentioned earlier, new highs, back in the 90s, people would get excited. Today, new highs, people get nervous, and probably because we went through, the technology bubble, the financial crisis, and so forth. So far, we have not seen really, the IPO market has not been, that robust. So I think having some of that excitement, some inflows into equities would be actually a positive. It's when it starts to get a little bit wacky, where we start seeing a lot of stocks come out IPO, and then you start seeing these 50, 100% jumps on a given day. We're just not seeing that yet. So as a first step, seeing Reddit, I think that would be a positive.
Keith Lerner, Truist Co-Chief Investment Officer. Keith, always a pleasure to get some of your insights. Thanks so much for the time here after the open.
Thank you.
Certainly. Well, coming up, we're tracking the public debut of social media platform Reddit, set to start trading this morning, ticker symbol RDDT. We've got more info on Snoo and this big company, Reddit, after the break.
All right, Bitcoin rebounding on the back of the Fed decision this week, now trading back above 67,000. Now, the cryptocurrency has certainly been on a wild ride, to say the least, since the approval of spot Bitcoin ETFs earlier this year. And it's also taken many other crypto-related stocks along for the ride. But as Bitcoin halving comes into view, could the crypto landscape be set for a new state of mind? We want to bring in Mark Palmer. He is Benchmark Senior Research Analyst. Mark, it's great to have you here. So we certainly have seen the seesaw action play out over the last several weeks. Not necessarily anything new when we're talking about the price of Bitcoin, but as we look ahead to the halving, what do you think the pricing activity is going to look like?
Yes, well, thanks for having me. Good to talk to you. what we are seeing right now is not unusual if you take a step back and look at the history of the halving as an event. What we saw in two previous halvings, which occurred in 2016 and 2020, is that there were significant retracements in price ahead of that event. In 2016, it was close to 40%. In 2020, it was more around 20%, which is essentially what we've seen in the 2024 cycle. What's going on here? I think it's a couple of things. One is the uncertainty ahead of the halving. When, for those who don't know, the Bitcoin halving is when the rewards that are paid to miners for each block that they mine are cut in half. So the profitability of the miners is cut in half, and hence a lot of miners tend to leave the market. It's almost like a wildfire that cleans out the Bitcoin mining space. That means that the amount of computational power or hash rate associated with Bitcoin mining goes down around the world. You end up seeing a lot of volatility around that event. But again, what's important from our perspective is what has happened historically after the halving. In 2016, we saw that volatility ahead of the halving. Then the price of Bitcoin went up 6x. In 2016, it was 17x actually. In 2020, it was 6x. The point being that we typically see an extended rally after the halving that goes on for something around 18 months.
Mark, to what extent does the ETFs and the inflows that we've seen, and now more recently, I guess some of the outflows from ETFs in recent days here, that event and that introduction into the market in itself, what does that introduce in terms of some of the perhaps atypical activity that might take place, given that Bitcoin is hitting all-time highs before the halving, and then you've got the ETFs, both of those things not happening before?
Yeah, that's a really good point, because the halving itself is a supply shock. The supply of new Bitcoin introduced into the market declines each time that we have a halving. What we are seeing this go round is also a demand shock with the introduction of 10 spot Bitcoin ETFs, all of the inflows that are associated with that. Why is that different? Because Bitcoin from its beginnings has been a retail instrument. It's the rare asset class where retail has led, institutions have really lagged behind. Now we're positioned to see more of a catch up on the institutional front. We're certainly seeing that in terms of the uptick. And yes, it is extending into the stocks that are associated with Bitcoin. A couple of the ones that we cover, MicroStrategy and BitDeer, which is one of the Bitcoin miners. We've seen significant pickup in both of those, which in some cases, MicroStrategy, is reflected in a premium to the underlying holdings of Bitcoin that it has. So we're going to see some volatility around all of this as we head into what is really a colossal event for the space.
Mark, while we are talking about it here, you mentioned MicroStrategy, and I'm curious because MicroStrategy's CEO, Chairman, I believe, Michael Saylor, was on Yahoo Finance last week. He was talking to Julie Hyman, and she was asking him just about the end game here for MicroStrategy as the company continues to buy more and more Bitcoin. I'm curious how you're evaluating that as an analyst. So not so much the short-term story here for MicroStrategy, but what you think that long-term reaction and pricing action could look like.
Yeah, you aren't going to find a stock that is going to be as correlated to the price of Bitcoin as MicroStrategy is. As I mentioned, the stock is, and it has in the past, been trading at a premium to the company's underlying Bitcoin holdings. I think what you see now is an opportunity for MicroStrategy to extend its reach beyond just holding Bitcoin, which is and will continue to be its core. But the management team and Michael Saylor, the executive chairman, have said that they really want to be a Bitcoin development company. People forget that Bitcoin is not just a cryptocurrency, it's also an underlying blockchain, and that there is significant building that is going on that blockchain. That is something that MicroStrategy is looking to get into, leveraging what had been the core of MicroStrategy from its founding over 30 years ago, which is its enterprise software business. So there's more to MicroStrategy than simply acquiring Bitcoin. That is the core of what the company is. It's the core of our valuation. And we do believe that MicroStrategy is very well positioned. We are assuming that the price of Bitcoin reaches 125,000 by the end of 2025. MicroStrategy will be among the beneficiaries of that upsurge.
And Mark, we got to go. Is MicroStrategy the company right now that is best positioned in terms of the managed blockchain solutions that are anticipated to be introduced to the market here?
It's actually newer to the game as it pertains to those. There are a lot of private companies that are developing or have been developing solutions, particularly on the infrastructure front.
Yeah.
But what's exciting is the fact that MicroStrategy clearly has the expertise. They have the network. They have the ability to add this component of their business.
Right.
And I think that that's going to be important in the longer term.
Mark Palmer, always a pleasure to get some of your time. Thanks so much for taking the time here with us on Yahoo Finance. Benchmark Senior Research Analyst Mark Palmer. Good to see you. Thanks. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
The price of Bitcoin has no shortage of catalysts, from the debate around regulation to whether it's a security or a commodity, and whether or not it really is digital gold. But one event is undeniable in its impact on the world's most premier digital asset, the halving. Every 4 years, the reward for mining the biggest cryptocurrency is cut in half. This happens in order to reduce the amount of coins in circulation. How is it calculated? Well, it happens specifically every time 210,000 blocks are mined. We can calculate the date fairly precisely with the knowledge that the average block time for Bitcoin mining is around 10 minutes. That calculation gets us very close to 4 years. Why is it needed? Because there's only so much Bitcoin available, 21 million to be exact. And like any other cryptocurrency, it needs to remain scarce to hold its value. So how often does this happen? Well, the halving takes place every 4 years. The first in 2012 decreased the award for creating a new block from 50 to 25 Bitcoin. The second halving in 2016, that lowered the reward further from 25 Bitcoin to 12.5 Bitcoin. Last time out, 2020. And you guessed it, we halved again. The block award dropping to 6.25 Bitcoin. So there's nothing wrong with your math here. This time around, the block reward miners will receive half, 3.125 Bitcoin. The big question, of course, what happens to the price? Now, the moves could be significant. In the past, we've seen Bitcoin rise after a halving event, though there's no certainty that this will always be the outcome. The other key focus is the outcome for the miners. The rewards that they're generating will, of course, diminish, and that's not great for an industry with a very high cost burden. Keep an eye on how the big publicly listed miners, the likes of Marathon and Riot, manage this event. As ever, talks of consolidation will no doubt do the rounds. No matter how you look at it, the event will have serious consequences for all crypto stakeholders and will be across all of the developments here at Yahoo Finance.
Happy top of the 10 a.m. hour to you. I'm Brad Smith alongside Shauna Smith. We are 30 minutes into today's trading session, big one. Let's take a look at how things are shaping up here on the day. Stocks moving higher after Reddit is set to make its big market debut and on the back of Fed Chair Powell's dovish stance. The FOMC maintaining its forecast for 3 rate cuts in 2024. Take a look at the S&P 500 futures, higher by about 0.5%.
Let's also take a look at some of those trending tickers. First up, we've got shares of sporting goods retailer Academy Sports and Outdoors. Well, it's sinking after reporting further deceleration in same-store sales growth, down 3.6% in the fourth quarter. The retailer's full-year outlook also falling short of analyst expectations. The consumer pulling back on discretionary spending, and you're seeing one of the retailers that are under pressure as a result, and shares off just about 8%.
From sports to pets, we're also watching shares of Chewy this morning. The pet supply retailer feeling some pressure after its near-term sales guidance came in well below Wall Street's expectations. Below those expectations, and despite a wider pet industry slowdown, the company did beat on fourth quarter results and full-year outlook projections.
And shares of Winnebago Industries moving to the upside, up nearly 6%. The recreational vehicle manufacturer in line with the street's expectations this quarter. Now, wholesale shipments were slightly constrained as dealers continued to closely manage inventory levels and also navigate some ongoing softness in the RV market. But you've got to move to the upside, and we also got a fist pump from Brad Smith.
I rallied big time for this one to make it into the show.
Oh, good.
There's a lot of Winnebago fans out there. Big RV energy here at the top of the 10.
Well, let's turn to some breaking news because we got another reading on the housing market. February existing home sales, well, they surged in February, at least on a month-over-month basis. They were up 9.5%. Now, on a yearly basis, though, sales did decline. They were off 3.3%. And digging into this report just a bit, on a regional basis, they rose in the West, South, and Midwest, but were unchanged in the Northeast on a month-over-month basis. On a year-over-year basis, sales declined in all 4 regions. We also, Brad, saw another uptick in the median price of existing homes that were sold. That was $384,500, an increase of nearly 6% from a year ago.
Yeah, National Association of Realtors Chief Economist Lawrence Yun, good friend of the show. Sorry for butchering the title, Lawrence. Appreciate it. Anyway, housing demand has been on a steady rise due to population and job growth, he says, though the actual timing of purchases will be determined by prevailing mortgage rates and wider inventory choices. And you think about the total housing inventory at the end of February, 1.07 million units. That was actually up 5.9% from January, 10.3% from 1 year ago. Unsold inventory, though, that sits at a 2.9 month supply at the current sales pace that is down from 3 months in January, but up from the February marker of about 2.6 months, February 2023 that was. So just some additional data for the folks out there. Micron, let's take a look at that. Ticker symbol MU, shares powering up after its AI-fueled earnings beat. The memory chip company also impressing Wall Street with its third quarter guidance. And so for more on what's ahead for the company and the stellar results, let's get to Cowen Managing Director and Senior Research Analyst, Krish Sankar. Krish, great to have you here with us. You were one of the analysts that came out and said, hey, pretty good quarter. I'm going to raise my price target here. And take us into your thesis here. What really stuck out to you on this company's earnings results?
Yeah, sure, Brad. Thanks for having me. A couple of things I would say. Number one is obviously a beat and raise was expected, but they literally blasted past those numbers. So even the most bullish expectations, they exceeded those numbers, estimates. Second thing is obviously there's a huge demand for high bandwidth memory, which is a type of DRAM. And that demand is largely driven by AI applications. And Micron literally had 0% share last year, and they're gaining traction in it. And that's a positive for the stock and the overall outlook over the next few years. And I think the third and more impressive thing was the fact that last year was a cyclical down year for memory. And DRAM and NAND price bottomed, I would say, about 6 months ago. They've been on an upswing. And as the pricing continues to improve and their factories start getting better utilized, they get this amazing margin expansion story. So pricing is good, helps the revenue. Pricing plus utilization helps the gross margins. That's why you saw earnings power. The street was expecting May quarter to have 9 cents in EPS. We were one of the highest on the street at 25 cents. They came and guided 45 cents.
Krish, what about inventory levels? Because that's been one of the issues with the stock from many on the street. What does that look like? And when you look out over the next couple of quarters, how are you assessing that risk?
Yeah, sure, Sean. I think the inventory levels are kind of come down quite a bit. Last year, you have that issue where inventory was pretty high at the customers and also at the suppliers like Micron. So they did have some inventory write down at Micron, but then the customers started using up their inventory. So I would probably say that on the AI server side, obviously AI server is growing. There's not any much inventory issue. With the regular servers, the non-AI servers, a lot of the inventories of the older DDR4 DRAM chip, and going forward, everyone is going to buy DDR5, which is a more later, greater version of the DRAM chip. And then obviously on the auto industrial side, it's close to getting normal, but it should probably normalize pretty soon. So largely speaking, I think inventory levels will come back to normal. I think over the next few quarters or into next year, you're going to see inventory levels probably start moving higher as people start building inventory for a surging demand environment.
On pricing, Krish, how are you looking out for the next, not just year, but for the next 2 years potentially here, when you have the company talking about expectations that DRAM and NAND pricing levels are going to increase further throughout calendar year 2024 and then in through fiscal year 2025 as well, giving them some much improved profitability. How does that factor into your kind of long-term outlook?
Yeah, sure. I think the pricing is kind of interesting. Pricing is really robust for high bandwidth memory, which goes for AI servers. On the DDR5, which is the non-AI server applications, I think pricing has been pretty good. A lot of the investments today are in high bandwidth memory, so later into the year, you should probably see DDR5 pricing actually get better because there the demand drivers are smartphones, PCs, and non-AI servers. And smartphones and PCs have bottomed, but they haven't quite recovered yet. They should probably start recovering into the back half of this year and into next year. So I would say into like the next 6 to 9 to 12 months, the pricing looks very optimistic. You know, if you ask me, well, how to think about pricing into back half of calendar 25 into 2026, I would say at this time it's anybody's guess. It's very hard to forecast that far out. But at this point, momentum is definitely in your favor. And because HBM is being driven by AI applications and there's tremendous demand for that, and HBM die size, or the chip size, is like almost 3 times bigger than your regular DRAM. It also helps absorb underutilization and helps with the pricing too.
Krish, when you take a look at these numbers and the surge in demand that we have seen, is Micron being viewed right now as one of the biggest beneficiaries that we are seeing from this boost in AI spending?
Yes, for sure. If you look at the AI chips, for example, like NVIDIA introduced something called H100, then the H200, and then recently they introduced the Blackwell chip, say B100. And every AI chip goes with a high bandwidth memory chip attached to it. And the H100 to H200, the memory attach rate went higher. And now H200 to the Blackwell, it's almost another 33% higher. So that basically says that for every NVIDIA GPU you're selling, there's more memory content attached to it. So that obviously is a benefit for memory companies. And then eventually, if there's more demand for AI servers, and as AI penetrates more through the world, it's going to be good for the memory companies. And obviously Micron is a good beneficiary. The other two players have been SK Hynix is very strong in HBM, and then Samsung is slowly coming up there.
Yeah, we certainly saw the reaction in Samsung stock earlier this week. All right, Krish, always great to talk to you. Thanks so much for joining us here on Yahoo Finance this morning.
Thank you.
Well, coming up, we are tracking the public debut of social media platform Reddit. It's set to start trading this morning under the ticker RDDT. We're looking at the opening bell, which has the mascot Snoo there, rang the bell. We've got more on the big debut right after the break.
You're my boy, Snoo. Yahoo Finance's Wealth is your guide, your group of advisors, planners, and jargon busters to help you save, build, and grow your money. How do I know if I'm saving enough for retirement? How do I know if it's right for me to go on that lavish vacation? Is it finally time to refinance my mortgage? How do I pay less in taxes? We'll get you the answers you need. Wealth, earning it, growing it, and managing it.
It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. Wealth cuts through the noise to help guide your financial decisions so that your money works for you. Wealth on Yahoo Finance premieres March 25th.
Investors are on the edge of their seats as the first big tech IPO of the year set to begin trading any moment now. Reddit, you can see the mascot Snoo on your screen right there, is expected to start at the higher end of, well, it priced right around $34 a share. Now, this comes after shares of the company Astera Labs jumped 72% in its public debut yesterday. We want to bring in Don Butler. He is Home Ventures Managing Director. Don, it's great to see you here. So we saw Reddit price at the top end of its range. Lots of excitement ahead of that first trade. What do you think we'll see today?
I actually think we'll see a similar sort of jump during the market day. One of the things we found is that oftentimes I think the metric of a good IPO from a banking standpoint is something like a 10% pop the first day. And so when I see the 17 from yesterday, I think, that feels, an indication of both the investor interest in new issuance, but also I think with Reddit in particular, you've got sort of this combination of both a well-known consumer brand, the first sort of public offering in several years of one of the, in effect, sort of a social network. And then on top of that, you have sort of data revenues coming in from AI. And so I think AI licensing And so I think what you're going to see is you're going to see investors who see this as a way to buy into the next wave of generative AI, aside from the means that they've had thus far. Thus far you've had companies like NVIDIA and others, and those have had a great run, but I think this gives investors a new chance to sort of buy into the next generation of technology here.
Yeah, Don, so we've had a lot of companies say that they're playing around, experimenting with, or putting some of their own capital towards R&D with regard to generative AI, either for productivity or for solutions that they could put into the market. How can Reddit come out and prove that to the street over time?
And so, if you remember, they had this licensing deal that they announced with Google that was, something on the order of like 60 million for the first year. And basically they can use their data to help train large language models. And I think the thing that'll be interesting is to see the training revenues. One, can they extend this to other? Can they build on those revenues with other large language model developers? And two, will we see that the way that large language models evolve, will it be a continuous training, and therefore each successive model that is built doesn't need to sort of access the full data set of that is out there, such as Reddit's data, or can it build off of its sort of existing learnings and go from there? And so I think what you'll see is in the first year, I think they're one of the few companies that actually has like material revenues that you can point to related to generative AI that is substantive. But then will that continue and build next year and the year beyond? I think that's the thing that's going to be really interesting to watch here.
Don, when it comes to some of the volatility that's expected because of the shares that they were offering to some of their users here, are some of those fears valid, or do you think the expectation that it's going to add to this volatility might be a bit overblown at this point?
My own experience in buying in, I worked for a company that offered a direct share program, bought in that. And in that case, as an employee of the company, as opposed to here where you have sort of early participants in the ecosystem, my experience has been that the people who benefit from those tend to be the people who have been with the company the longest, or in this case, the people who've been posting on Reddit or moderating forums for the longest period of time. And I actually tend to think that they'll be more loyal to the platform. Like I think they, I think you'll see some volatility because of the broader investor demand. I think that'll lead to a jump. And yes, you might see some people sell some of their shares, but I don't think it'll be quite as dramatic of a sell-off as others have indicated. My own experience was, the people who understood the company the best and sort of were aligned with the long-term success of the company the most tended to be people like the folks that I think are going to be participating in the directed share program.
And Don, when we think about Reddit as a company and how it's defining itself versus companies that went public prior to it, Pinterest didn't want to be looked at as a social media company. Snap said they were a camera company when they went public.
That's
how
right. Yeah.
should the street be evaluating Reddit as a company?
It's funny. When I think of analogs, I actually think of folks like Pinterest. So I think that's actually quite accurate. One of the things that and to give you an example of why that is, it's interesting. We used to do quite a bit of investing in the ad tech industry. So as I was looking at the IPO, I reached out to friends of mine who were still placing advertising inventory at consumer brands and said, what's the experience of being an advertiser on Reddit? How does that compare to other brands? And basically it's like, well, it's sort of similar to buying on Pinterest or similar to buying on Nextdoor or these other communities where you have very high engagement, but at the same time, it's not the performance marketing machine that you have with companies like Meta or Google or Amazon these days.
Really interesting stuff. Don Butler, thanks so much for taking the time to join us here. Again, we are expecting the first trade of Reddit any minute now. Don Butler of Tomvest Ventures, Managing Director. Thank you.
Thank you.
And also stay tuned. Brian Sozzi is going to be speaking with Reddit's CEO Steve Huffman live from the floor of the New York Stock Exchange. That's happening later this morning. Let's take a look at a trending ticker that we are watching here at Yahoo Finance, and that's Accenture. Shares are under pressure, off nearly 7%. The company cutting its full-year revenue forecast. It's saying that it expects revenue growth of 1% to 3% in 2024. That's opposed to the prior 2 to 5% growth it had been expecting. And digging into these results and exactly what this could signal or does signal about demand going forward. They did see a bit of strength within the AI offerings and the IT spending, which is happening there. but they are seeing some weakness in other areas, which is one of the reasons that we did see a bit of a reaction to the stock. We are seeing a reaction to the stock in intraday trading today.
Yeah, consulting revenues took a little bit of a hit as well. That for the quarter was $8.02 billion, and folks will know that that's about a 3% decrease in both the U.S. and local currency compared with the second quarter of fiscal 2023. And so that considered, you've got the managed services revenue. That was higher by about 3%. So all things considered here, when you kind of look at both of these businesses, which are really the biggest and lion's share contributors to that total and holistic revenue number, which actually came in flat, you're going to want to hear more about how this company is really within the business outlook that it even did update and provide to the street that is disappointing, being factored into the stock price here on the day, where they're seeing more demand for consultation in generative AI as well. A lot of different spends that companies could potentially be putting forward. It's a clear market opportunity for any type of consultancy business out there. Larger question of if some of the tech behemoths that have also added on consultation to their business structures, like an IBM, if they're picking up more of that perhaps windfall or market share as more companies are trying to figure out how to diligently spend towards some of their AI ambitions right now.
Yeah, exactly. In terms of those AI projects, Jefferies calling out in their reaction note that they are seeing, or they expect to see continued acceleration, given the fact that they are seeing this boost here for the fiscal second quarter, bookings totaling $600 million, up 50% quarter over quarter. So it just goes back to the AI excitement, the importance of companies, or what they feel is very important to be investing in AI here as they position their companies for the future. All right, we'll keep right here on Yahoo Finance. Interest rates holding higher for longer. We're going to talk about what that means for the M&A space next.
This week, the Fed maintaining its outlook for 3 rate cuts this year. This could have some significant implications for companies looking to jump into the merger and acquisition space as the cuts might not come soon enough. To break down what this means for the M&A market, we've got Jim Gold, Stewart Partners CEO. So first and foremost, just give us the correlation between deal-making activity and the Fed's rate policy here.
I think the deal-making activity is very robust right now. I think you see the real impact is on the lower end of the spectrum where, traditionally you might see one advisor buying another advisor's practice, and when they go to borrow that money now, that's like getting a Visa card, and suddenly it's like, wait, maybe we need to talk about the value here, how long I need to pay you over time. So I think you're seeing it more there, and I would sort of compare it to, we sometimes hear about national real estate. What is national real estate doing? But in your market, it may be completely different. So I think that on the low end of the spectrum, the high interest rates definitely having an impact.
And how is it more specifically impacting just the wealth management space overall? Because we've been talking a lot about the fact that that space is changing pretty dramatically. We're expecting to see an uptick in consolidation. What more specifically do you expect that to look like in the coming years?
I think there's a real quiet revolution going on. If you look at the data of the industry, the big traditional firms are losing market share, and that market share is going to the independent space in one form or another. As I like to say, we're sort of passing each other on the elevator. One's going up, one's going down. So I think those firms will always have a place, but this change is real, and it's actually accelerating.
You're also tracking some significant changes in the wealth management sector. What are those changes that you're identifying at this juncture?
What you see is, listen, the next generation advisors overwhelmingly want to be in an independent structure. They want to have more autonomy. They want to have more flexibility. And I think sort of the big traditional firms are sometimes very restrictive for them. So what you're seeing is that the overall wealth management, who's managing the assets, there's a massive shift going on. It's a volcanic, change. It's not a glacial change. And I think people are starting to notice that trend. You see the Cerulli data supports this continuously.
And when we talk about the digital disruption end of it, what does that look like, and how is that going to contribute here to what you're expecting to see just in terms of more changes coming within the industry?
Yeah, the digital is amazing, and I think we've always been a believer in renting technology. You look at the technology of today, and in 5 years, the technology of today is going to be not useful anymore. So I think we try to adopt technology that helps us serve our clients better, whether that's portfolio analysis tools or ways to interact with them. We were just chatting about the effect of Zoom and things like Teams meetings, where 5 years ago that was unheard of, and now anyone could sit here all day and talk to clients all over the country without leaving their desk.
All over the world, yeah. And
exactly.
So all these things considered, and we think about the digital disruption, there is one major disruption that we're continuing to track right now, highly anticipated to impact productivity, to impact potential bottom lines for businesses like NVIDIA, Micron, and it's artificial intelligence and generative AI specifically. Right. How does this newest iteration of AI stack up in terms of some of the deal making that's starting to come forward right now, even for companies that have yet to even think about making a public market debut?
Yeah, I think the technology is always interesting to me. I think in wealth management, you've seen a trend that people sort of fit in various silos, and you have the do-it-yourselfers who are probably much more open to new technologies and ways to manage their portfolios. We find that people who have real assets want advice, they want to talk to someone, they want counseling, and sometimes being a great advisor is more of like family therapist than it is about the numbers.
What would you say is, from the clients that you're speaking with, their biggest concern at this point, the biggest worry?
It's always valuations in the short term. If the market's bad, they want to know when it's going to get good, and if it's good, like right now, they say, when's it going to get bad and what should we be doing? So you have to listen, the cliches are there for a reason. You have to take the long approach. I think you have to look at your own individual timeline. No answer is a bad answer. It's the answer you're most comfortable with. And if you can't sleep at night with the way your portfolio is set up today, you should probably change your portfolio.
All right, Jim Gold, Stewart Partners CEO, thanks so much for joining us here
My pleasure.
today.
Thank you.
All right, let's take a look at some of those commodities moving to the upside. Copper prices are steadying after hitting an 11th month high earlier this week. Now the surge in commodity pricing driving mining stocks higher as well, with shares of company like Teck Resources and Capstone Copper both climbing in the last month. For more on this, we want to bring in Sam Crittenden. He is RBC Capital Markets mining analyst. Sam, just first your reaction to this massive run-up that we've seen in copper prices and where copper is trading today.
This has actually been expected for a few months now. So if you go back to Q4 of last year, saw a number of supply disruptions in the copper space. So there's a large mine in Panama, Cobre Panama, that went offline. You also saw some production downgrades from some of the larger companies, and that basically took 3% out of our supply estimate for this year. And so that flipped what we had as a surplus coming into 2024 to more of a deficit, and that's really driven these higher prices. People were expecting that for a while, and you're finally starting to see that happen here in the last few weeks.
And so if this was expected, Sam, what are the kind of top ideas that you're looking towards to continue to implement perhaps in the copper space?
Yeah, so our top picks in the equities would be Teck Resources, as you mentioned, Capstone Copper, and Ivanhoe Mines. Those are three names we think all three of them have excellent growth prospects for this year and beyond, and those would be our top ideas in the sector.
In terms of where the pricing, that upside, what does that look like here from current levels?
Yeah, so our price estimate for this year is $425, and we have that going to $450 for next year. So we don't see those supply disruptions I mentioned easing anytime soon, and so I think you will see constrained supply for the foreseeable future. And if demand picks up, so there are still some concerns on the demand side. China's been a little bit sluggish in recent weeks coming out of the New Year holidays. But if that picks up as we head into summer construction season, typically a strong period over the next few months, we think you'll see that follow through on the demand side and can drive higher copper prices from here.
You know, it's really interesting. We had a guest on a few weeks back, I want to say, who was talking about the correlation between the semiconductor demand that we're seeing and copper because of some of the interconnects that are used. I wonder where that factors into your thesis here.
Yeah, so I mean, that's a part of it, but I think broadly, the energy transition is the biggest driver that's going to drive increased copper demand over the next several years. And I mean, I think as we build out renewable infrastructure, that's a key component. Electric vehicles use 3 times the amount of copper. All of the renewable energy that's being built out is very copper intensive. And data centers and some of the other electronic components certainly are copper intensive as well. So it all feeds into our positive thesis for copper on growing demand over the next several years.
And some of the challenges, though, or headwinds, I should say, cost inflation, social issues, scarcity of quality projects. How much does that limit that upside move then that we could see within copper?
Yeah, I mean, it's case by case with some of the equities, right? And so some of the companies have some challenges in certain countries, and some of those cost inflation issues hit them harder than others. But I think it underscores the point that it gets harder and harder to bring on new copper supply. And that is a challenge the miners are facing. We're going to need a lot of copper in the future for the energy transition, as I mentioned, yet it's getting harder to build that supply. We've seen a number of new projects come online over the last 2 or 3 years, but those are really the low-hanging fruit in terms of copper mines that could be built in a timely way. It just gets harder from here, and all the social pressures around mining and some of that cost inflation really factors into the decision to build new projects, and to me means justifies higher prices because the incentive price to mine copper and build new projects is only going higher.
Sam, you also cover zinc, nickel, iron ore, and metallurgical coal. And correct me if I pronounce that incorrectly. It's not every day I get to say it. But you've been tracking this move higher and anticipating this move higher in copper. Where else do you think the next breakout could be?
Yeah, that's a good question. Copper would remain our preferred metal because I don't, like I said, it's still below our price expectations. Some of the other commodities, there's adequate supply, as is the case with iron ore. There just appears to be, I mean, there's been some supply constraints here and there, but fundamentally there's enough supply over the next 5-10 years. And if anything, demand might be plateauing, whereas copper is really kind of the one we're most focused on because of those demand components where you do see that. I mean, historically, copper has been, closely linked with economic cycles, as are most of these commodities. But that new layer of demand from electrification is really, to me, what sets copper apart from some of the other commodities. Nickel is used in electric vehicle battery components. It's an interesting metal, but there's been a big growth in supply in Indonesia that's pressured the nickel price in recent months.
Sam Crittenden, who is the RBC Capital Markets mining analyst. Thanks so much for taking the time this morning, Sam.
Thanks a lot.
Certainly. Coming up, we're tracking the public debut of social media platform Reddit, set to start trading this morning under ticker symbol RDDT. Right now, it's priced at, well, actually, it's in that indicative window right now, it should be, and $34 a share is where we're seeing the pricing have already taken place. We've got more on Yahoo Finance after the break. Snoo, there it is. Yahoo Finance's Wealth is your guide, your group of advisors, planners, and jargon busters to help you save, build, and grow your money. How do I know if I'm saving enough for retirement? How do I know if it's right for me to go on that lavish vacation? Is it finally time to refinance my mortgage? How do I pay less in taxes? We'll get you the answers you need. Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. Wealth cuts through the noise to help guide your financial decisions so that your money works for you. Wealth on Yahoo Finance premieres March 25th.
The price of Bitcoin has no shortage of catalysts, from the debate around regulation to whether it's a security or a commodity, and whether or not it really is digital gold. But one event is undeniable in its impact on the world's most premier digital asset, the halving. Every 4 years, the reward for mining the biggest cryptocurrency is cut in half. This happens in order to reduce the amount of coins in circulation. How is it calculated? Well, it happens specifically every time 210,000 blocks are mined. We can calculate the date fairly precisely with the knowledge that the average block time for Bitcoin mining is around 10 minutes. That calculation gets us very close to 4 years. Why is it needed? Because there's only so much Bitcoin available, 21 million to be exact. And like any other cryptocurrency, it needs to remain scarce to hold its value. So how often does this happen? Well, the halving takes place every 4 years. The first in 2012 decreased the award for creating a new block from 50 to 25 Bitcoin. The second halving in 2016, that lowered the reward further from 25 Bitcoin to 12.5 Bitcoin. Last time out, 2020. And you guessed it, we halved again. The block award dropping to 6.25 Bitcoin. So there's nothing wrong with your math here. This time around, the block reward miners will receive half, 3.125 Bitcoin. The big question, of course, what happens to the price? Now, the moves could be significant. In the past, we've seen Bitcoin rise after a halving event, though there's no certainty that this will always be the outcome. The other key focus is the outcome for the miners. The rewards that they're generating will, of course, diminish, and that's not great for an industry with a very high cost burden. Keep an eye on how the big publicly listed miners, the likes of Marathon and Riot, manage this event. As ever, talks of consolidation will no doubt do the rounds. No matter how you look at it, the event will have serious consequences for all crypto stakeholders and will be across all of the developments here at Yahoo Finance.
The high costs of dining out are weighing on restaurants and driving some consumers away. Shares of Darden falling this morning as the restaurant operator reported a revenue miss for the quarter as fewer customers avoided its widely known brand. Fewer customers, we should say, went to the widely known brand Olive Garden, which is typically seen as a bright spot for the company. Deeper dive into the company's quarterly results. We're joined by Greg Frankfurt, Guggenheim Securities Senior Analyst. Greg, help us make sense of what Darden is seeing right now and why investors are fading it here this morning.
Yeah, I think it's the outlook for the business and what they are seeing in the consumer is challenged, and particularly at the low end. One of the things that we've seen kind of steadily from a lot of these companies the last few quarters is them talking a little bit more concerned about the low-income consumer. Darden called it out this quarter as under $75,000 household customers pulled back materially. Over 150,000 actually saw transactions grow. And so there's clearly a dichotomy in the consumer that Darden saw in its results in the quarter.
And is that something that you're expecting to continue here, a trend that we will see in the current quarter as well?
Yeah, look, I think things are likely, they guided things to get a little bit better. They put up a down 1% comp in the third quarter. They're guiding to the fourth quarter to be down 50 basis points to up 100 basis points. One of the things that we've seen to start January and February is we've seen a tougher weather environment in the country. We've also seen delayed tax refunds that we think have weighed on the consumer. We think some of that will flip here as we get into March and April. But generally, this pressure on the low-income consumer seems like it's been building for a few quarters. And is clearly at a little more of a breaking point.
What's the management team saying? How are they responding to this, Greg?
I think one of the things that's clear, and one of the reasons why we've had a buy on Darden is because they are outperforming the industry. So despite the fact that same-store sales were down 1%, that was several percent better than where the industry was over the 3 months that they reported earnings. And so I think Darden's continuing to try to outpace the category, even if there's category pressure. And that's their goal. I mean, they're looking to respond with offers that are tactical to the guest and to try to be on brand with what the consumers are looking for.
And what do you think that pricing strategy is going to look like as we do see inflation come down just a bit, not as big of a headwind for Darden, for other players within the space potentially here over the next several quarters? How do you expect, or how are you pricing in that they are going to adjust those pricing plans?
Yeah, it's been tricky because a lot of these brands put in place pricing actions over the last 12 months, and were surprised by the level of inflation. Darden actually ratcheted down their commodity inflation this quarter for the full year from 2% to 1.5%. They're expecting it to pick up a little bit here going forward, and we're watching beef pretty closely. You've seen beef go on a bit of a run the last month or two. But generally 2.5% to 3% pricing is kind of what they're looking for. And that seems pretty appropriate. They've underpriced the category here for 5 years, and they've created a big pricing and value gap. And we expect them to continue on that strategy.
When you think about the targets for where Olive Garden is going to continue to meet their customers at, those who are still willing to come in the restaurant experience versus those who are just comfortable sitting at home. And I think you and I have talked about the prominence of delivery that really came forward over the pandemic. Where is that still lingering positively for Darden and some of their segment subsidiaries versus where customers are clearly trying to come back in for that dining experience, and I'm looking specifically at this fine dining segment, which I still need to run some calculations on here, admittedly.
Yeah, I think what Darden has been kind of the big holdout in terms of going into third-party aggregator, DoorDash and Uber, small order delivery. They've kind of bucked the trend and kind of been the other holdout besides Domino's, who just kind of capitulated in the last 6 months. And I would say that one of the things that we're seeing in the industry is delivery sales have generally been under a little bit of pressure. So I don't think that explains Darden's weakening sales, and they're outperforming the category. It feels like it's more of a macro challenge, and it's a challenge for the low income, particularly the under $75,000 households. They said they lost transactions actually in all of their brands at the under $50,000 income households. And so that's clearly the dynamic here.
Greg Frankfurt, always great to talk to you. Thanks for joining us here this morning. Guggenheim Securities, a senior analyst. Thanks.
Thank you.
Keep right here on Yahoo Finance. We've got much more of your market action ahead. Stay tuned. Breaking news, the Justice Department, alongside 16 attorneys general, filing an antitrust lawsuit against Apple just moments ago. The DOJ accusing Apple of violating antitrust laws by blocking its rivals from accessing both hardware and software features on its iPhone devices. Our legal reporter, Alexis Keenan, joining us now on set with these details. Alexis, what are we learning?
Yeah, so far, this is what Bloomberg is reporting. We're waiting to get a copy of the suit. And what it says is that these AGs and the DOJ have filed antitrust claims against Apple in federal court in New Jersey, and it's targeting the iPhone ecosystem, saying that the company maintains its dominance over that ecosystem by blocking competition for services like financial services businesses. So think about payment apps, also device trackers, things like the AirTag. And what they're saying is that Apple is stifling innovation, stifling competition, alleging that the company is using its power over this app distribution on the app phone in order to block competition. Now, in response, Apple is saying this: the lawsuit threatens who we are and the principles that set Apple products apart in fiercely competitive markets. If successful, it would hinder our ability to create the kind of technology people expect from Apple, where hardware, software, and services intersect. It would also set a dangerous precedent, they say, empowering the government to take a heavy hand in designing people's technology. Now, this is a major target against Apple, because if you take a look at its annual revenues for 2023, you have the iPhone, right, as its biggest driver of revenue, $200 billion last year. So this is a major threat to the company. And if you go back to the antitrust lawsuit that Epic and Apple were battling out over the course of the last few years that the DOJ joined, that lawsuit, it had to do with the App Store, but importantly, it was targeting part of this ecosystem. Now, you have the iPhones, the App Store, the iWatch, iMessage, AirTags, all potentially involved in this suit, but just such a big deal. And during the testimony in that Apple and Epic trial, Tim Cook got up, took the stand, and what he was talking about was that Apple needs to produce its products in this way, in this ecosystem, because they say it protects people's data security, protects their personal privacy. This, Apple said, was of pinnacle importance to the company. They want to be able to produce products this way. So I would not be surprised if, when we hear Apple's response further in this case, if we might hear echoes of that. And that's what I'm seeing here in this statement from Apple, saying that it would be a dangerous precedent for the government to have a hand in trying to tell companies how they should do things like protect data.
And precedent is the key word here, too, because it's not just the U.S. and how they would potentially look at it, regulators here, but then also elsewhere around the world. Where might they face similar tests? And how could that mindset that now the DOJ and multiple attorneys general that they're moving forward with, how could that permeate more broadly and potentially impact Apple as well?
Yeah, it already has, arguably, right? Because you had the EU, the European Commission, its antitrust regulator there just last week or so, a $2 billion fine against Apple, but it was targeting the way that the company handles music apps within the App Store. So most of the litigation so far, most of the antitrust complaints have been specifically about the App Store. So what this does is it really broadens that antitrust lens. We still need to take a harder look and a more detailed look at this complaint to get to the specifics here, but no doubt, this is a major broadening of what is being targeted in Apple's products.
And Alexis, I'm curious just in terms of what this could also tell us just about further pressure for not just Apple, but also for some of the other tech competitors out there. Very different business models. Obviously, this specifically targeting the App Store and the iPhone. But what this could, I guess, lend to some of the activity that we could see given the focus that we see from the DOJ on Apple at this point.
Yes, and not just DOJ, the FTC as well, yeah. Right. So Apple's been kind of this latecomer getting on the defense side of these antitrust arguments, you have the DOJ's case against Google in Washington, D.C., pending against search and search advertising. Any minute now, we could get a decision from the judge in that case. That one's being handled by a judge. Big case against Google there. Also, you have the FTC going after Amazon, going after Facebook in unsettled cases. You have another case with states going after Google on similar grounds. So Apple now being added to this fray. Certainly the Biden administration making these major pushes on the antitrust front against these big tech companies. But also these investigations, many of them started with the Trump administration. So we can't necessarily say it's all attributable to the Biden administration. And look, this case, this Apple case, this will extend long past this current administration. And if the history is any indicator, we could see these cases go out as far as decades, right? In the case of Microsoft, and they can go on quite a long time.
Yeah, absolutely massive case for us to track going forward. Alexis, thanks so much for joining on the Snap here to make sure that we can break this down. Appreciate it.
All right, let's take a look at shares of Apple here before we let you go, because Apple under pressure following the suit here from the DOJ. You're looking at losses just about 2% here in intraday trading. Keep it right here on Yahoo Finance. Much more ahead. You're looking at losses now 3%. Much more ahead. We'll be right back.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Stocks looking to build on a record-setting rally. The three major indexes closing at all-time highs on Wednesday after the Fed's rate projections. Later this hour, we'll dig into how investors should play this record-setting run. And breaking news, the Justice Department, alongside 16 state attorneys general, filing an antitrust lawsuit against Apple just moments ago. We'll dig into the lawsuit and what it will mean for one of the world's most valuable tech companies. As you can see there, the stock down more than 3% so far. And a big day for the IPO market. Reddit making its highly anticipated public debut on the New York Stock Exchange. We'll break down all the latest on the investors' appetite for this social media company. But first, let's take a look at how the major indices are faring an hour and a half into the trading day. Looking at the Dow there, clearly off to the races, up about 330 points on the day, about 0.8%. The S&P 500 also about 33 points there, about 0.6%. Tech-heavy Nasdaq there, also to the upside as well, although pairing some of those gains, as we mentioned there, for some of the action that we're seeing with Apple, weighing a little bit on the Dow and the Nasdaq, but still green across the board here. Let's also check in on the Treasury market in the aftermath of what we heard from the Fed yesterday, staying the course. We're looking at the 5-year currently up about 0.5% on the day, the 10-year sitting at 4.28, and the longest term 30-year yield relatively flat, but sitting at 4.46. Well, it is Reddit IPO day. Investors are on the edge of their seats as the first big tech public offering of 2024 is set to begin trading any moment now. Yahoo Finance's Inez Ferre is standing by to give us the latest on the pricing action that we're expecting. Hey, Inez.
Hey, Rochelle, yeah, and we do not see yet an indication as to where the shares will open. First, just to give you a little bit of background, there's a lot of anticipation going on the floor of the stock exchange as everyone awaits that first indication. It's basically a spread to see around the range where it will open. When that becomes to get narrower and narrower, that's when you can expect that final listing to take place. But look, Reddit priced its shares at $34 each. That's on the higher end of that expected range. They raised $748 million. This is valuing the company at around $6.4 billion, down from its private round funding back in 2021 when it was valued at about $10 billion. As far as the company's balance sheet, its revenue last year was $804 million. That was up about 21% a year over year. Its net loss was narrower from the prior year, but it is not profitable yet. Its net loss came in at around $90 million. So there is a lot of anticipation as to how this IPO will shake down, how it will go, and what this means for the IPO market after we've seen a lull in the market for the last couple of years. Something very interesting that was in their S1 filing was they also talked about AI, because the majority of Reddit's revenue comes from advertising, 98% of it. So they talked about other ways that the company can generate revenue, AI, data licensing being one of them. And one other interesting note, Rochelle, is also that the company had set aside about 8% of the shares that it was offering to qualifying users of Reddit, to their moderators as well. No lockup period for those shares, which is kind of unusual when it comes to IPOs. So some analysts speculating that you could see some volatility with the shares. Rochelle?
Indeed. On top of the usual volatility that we already tend to see with IPOs. Yeah. Appreciate you breaking that down for us. Our very own Inez Ferre. Well, as we gear up for Reddit's IPO, we want to take a trip down memory lane at past social media public debuts. Yahoo Finance's Jared Blickery joins us with that breakdown. Been a minute since we've had a pure play social media company here.
Yes, it has. And check out this leaderboard. Who's at the very top there? It's not Meta. It's Facebook, way back in the day, listing on May 18th, 2012. That was a horrendous black eye for the Nasdaq marketplace because the IPO did not go as planned. Lots of hiccups. And in fact, the company was called face plant because of that disastrous IPO for a brief time back in 2012, but investors hopefully forget these things. Now, Snap is another large one. That's another one that came to market in 2017. Compared to Facebook, it was quite a bit smaller. Facebook raised $16 billion or sold $16 billion. Snap only sold about $4 billion. And by the way, these are not the valuation numbers, just how much they sold. But then you go down the list, and the other players, admittedly, quite a bit smaller here. And we didn't even put all of them them on the screen, but for what it's worth, Bumble coming to market in February of 2021 and Pinterest in 2019 before the pandemic took hold. But I thought it'd be interesting to chart some of the price action here and just to go back to some of the key features of the offering. One of the last things that Ines said was very key here, that there's a bunch of shares that have been allocated to users here, potential Redditors, 1.76 million of those shares that could come into the market and be sold at any time. They would not be subject to a lockup agreement. So as Ines said, could provide some extra volatility. But I thought it'd be interesting. You know, you take a look at the biggest name here. Here's Meta. Let's go to a max chart. Let's not forget, and you can't even see it here, but the stock was down 60% in the months after its IPO, and it took a year for it to get back in the green above that initial price. There's never a hurry to get into these IPOs.
Indeed. Appreciate you breaking that down for us, our very own Jared Blickery. Well, we're going live now to the United States Attorney General Merrick Garland on that Apple decision. Let's tune in.
For developers, that has meant being forced to play by rules that insulate Apple from competition. And as outlined in our complaint, we allege that Apple has consolidated its monopoly power, not by making its own products better, but by making other products worse. Apple carries out its exclusionary anti-competitive conduct in two principal ways. First, Apple imposes contractual restrictions and fees that limit the features and functionality that developers can offer iPhone users. Second, Apple selectively restricts access to the points of connection between third-party apps and the iPhone's operating system, degrading the functionality of non-Apple apps and accessories. As a result, for most of the past 15 years, Apple has collected a tax in the form of a 30% commission on the price of any app downloaded from the App Store, as well as on in-app purchases. Apple is able to command these fees from companies of all sizes. Apple has also suppressed the emergence of programs like cloud streaming apps, including gaming apps, as well as super apps that could reduce user dependence on Apple's own operating system and expensive hardware. And as any iPhone user who has ever seen a green text message or received a tiny, grainy video can attest, Apple's anti-competitive conduct also includes making it more difficult for iPhone users to message with users of non-Apple products. It does this by diminishing the functionality of its own messaging app and by diminishing the functionality of third-party messaging apps. By doing so, Apple knowingly and deliberately degrades quality, privacy, and security for its users. For example, if an iPhone user messages a non-iPhone user in Apple Messages, the text appears not only as a green bubble, but incorporates limited functionality. The conversation is not encrypted, videos are pixelated and grainy, and users cannot edit messages or see typing indicators. As a result, iPhone users perceive rival smartphones as being lower quality because the experience of messaging friends and family who do not own iPhones is worse, even though Apple is the one responsible for breaking cross-platform messaging. And it does so intentionally. For example, in 2013, a senior executive at Apple explained that supporting cross-platform messaging in Apple Messages, quote, would simply serve to remove an obstacle to iPhone families giving their kids Android phones, close quote. In 2022, Apple's CEO was asked whether Apple would fix iPhone to Android messaging. The questioner added, quote, not to make it personal, but I can't send my mom certain videos, close quote. Apple's CEO responded, buy your mom an iPhone. In addition to selectively controlling app distribution and creation, we allege that Apple is violating the law by conditionally restricting developers' access to the interface, which is needed to make an app functional on the Apple operating system. For a product like a smartwatch or a digital wallet to be useful to an iPhone user, it must be able to communicate with the iPhone's operating system. But Apple creates barriers that make it extremely difficult and expensive for both users and developers to venture outside the Apple ecosystem. When it comes to smartwatches, Apple not only drives users to purchase an Apple Watch, which is only compatible with an iPhone, it also uses its technical and contractual controls to make it harder for someone with an iPhone to use a non-Apple smartwatch. And when it comes to digital wallets, Apple's exclusionary conduct goes a step further. Digital wallets allow users to store and use passes and credentials in a single app, including credit cards, personal identification, movie tickets, and car keys. Apple Wallet is Apple's proprietary digital wallet on the iPhone. Apple actively encourages banks, merchants, and other parties to participate in Apple Wallet, but it simultaneously exerts its monopoly power to block these same partners from developing alternative payment products and services for iPhone users. For example, Apple has blocked third-party developers from creating competing digital wallets on the iPhone that use what is known as tap-to-pay functionality. That is the function that makes a digital wallet, well, a wallet. Instead, Apple forces those who want to use the wallet function to share personal information with Apple, even if they would prefer to share that information solely with their bank, medical provider, or other trusted third party. When an iPhone user puts a credit or debit card in Apple Wallet, Apple inserts itself into the process that would otherwise occur directly between the user and the card issuer. This introduces an additional potential point of failure for the privacy and security of Apple users. And that is just one way in which Apple is willing to make the iPhone less secure and less private in order to maintain its monopoly power. The Supreme Court defines monopoly power as, quote, the power to control prices or exclude competition. As set out in our complaint, Apple has that power in the smartphone market. Now, having monopoly power does not itself violate the antitrust laws, but it does when a firm acquires or maintains monopoly power, not because it has a superior product or superior business acumen, but by engaging in exclusionary conduct. As set out in our complaint, Apple has maintained its power not because of its superiority, because of its unlawful exclusionary behavior. Monopolies like Apple's threaten the free and fair markets upon which our economy is based. They stifle innovation. They hurt producers and workers, and they increase costs for consumers. If left unchallenged, Apple will only continue to strengthen its smartphone monopoly. But there's a law for that. The Justice Department will vigorously enforce antitrust law. Enforcing the law protects consumers from higher prices and fewer choices. That is the Justice Department's legal obligation. That is what the American people expect. That is what they deserve. I am grateful to the attorneys and staff of the Department's Antitrust Division for their tireless work on this case on behalf of the American people. I'll now turn the podium over to the Deputy Attorney General.
All right, well, that was U.S. Attorney General Merrick Garland there discussing the antitrust lawsuit that the Department of Justice has filed against Apple. The DOJ accusing Apple of violating antitrust laws by blocking its rivals from accessing both hardware and software features on its iPhone devices. Now, this is the culmination of a 5-year probe into one of the world's most valuable technology companies. Joining me now on this is Carl Szabo, NetChoice Vice President and General Counsel. Thank you for joining me this morning. So, as we heard there, the Attorney General laying out the grounds for this antitrust lawsuit. What are the key takeaways that we need to keep in mind at the beginning of this?
Yeah, so this is a really long process. And what we have seen in similar efforts by the Biden administration's Department of Justice and the Federal Trade Commission when it comes to antitrust is a kind of Hail Mary pass when it comes to antitrust law. What you heard from the AG was a lot of declarations of monopoly or declarations of bad business practice, when in fact we as Americans know that actually if we want to go buy a device, we actually have two clear choices. we have Apple, and we have Android. So already the argument that there's a, quote, monopoly on smartphones just doesn't even make sense to the average American. But this will be a really long process, and kind of the process is the pain for a lot of these businesses, because as it goes on, Apple will continue to move away from innovation, creating new services and new features for our phones out of fear that this will be then used against them by the Department of Justice as part of this frivolous lawsuit. One of the other important components of this is you didn't hear any real claims of consumer harm. They said consumers are being harmed, but they didn't actually go in to explain how. How are consumers being harmed? Because there's really no evidence of consumer harm. What you have seen is devices continue to get better and better, and that is evidence of a clear, competitive, and functioning marketplace. So the Department of Justice has a real uphill climb when it comes to the courts. Just saying somebody is something doesn't make it so.
And Carl, to your point, though, the focus did seem to be on the exclusionary conduct. So not just for certain users. They mentioned, Android users with the green bubble, some of that cross-platform messaging becoming difficult, and that they were purposely sort of degrading or limiting the functionality there. How high of a barrier is that to try and cover if you're Apple to really combat that argument?
Yeah, so essentially, as long as Apple can show compelling business purposes for what they are doing, the courts have typically gone on the side of businesses. So Apple will say, look, the reason we don't allow you to install your own apps is because we know the security problems. And one of the reasons why people like Apple ecosystem is because they know their devices are safe and secure. Just think about your laptop computer, where we're constantly worrying about installing malware or spyware. That doesn't really happen on iPhones, and that's because of the closed ecosystem. With respect to payment processing, one of the reasons why it has typically only been allowed through Apple is because as a parent, for example, I get an alert every time my kid tries to make an in-app purchase. If we allowed other payment processors, I wouldn't have such a recourse on my device. So a lot of the complaints that you're hearing are easily dismissed by Apple because of the security and consumer benefits that are being used to offset whatever claims that a business has.
And Carl, just quickly, they also mentioned that 30% commission when it comes to developers who want to be on the App Store. How strong is that argument?
So this is a little bit of the legal jujitsu that the Department of Justice is trying to do. I actually read their complaint. They claim that it can be up to 30%, but in reality, an overwhelming majority of apps pay $0, 0 cents, 0% to be hosted on the App Store. In fact, it is only the largest of corporations that even begin to pay a 30% commission or service for being hosted on the App Store. And that's the same service fee that Microsoft charges on the Xbox. And seemingly the Department of Justice hasn't weighed in on that as anti-competitive. So what you're seeing is kind of the use of a big number that applies to only a small fraction of big corporations being used to try to explain the entire ecosystem. That's just not what's happening. Most apps pay $0 on the App Store, and many apps can actually pay $0 even if they're big. Netflix, for example, will not let you sign up through their app. And in fact, Netflix does not pay a single cent to Apple for being hosted on their service.
Certainly some important context added there. Carl Szabo, thank you so much for joining us on this breaking news story. We'll be right back. Stay with us on Yahoo Finance.
Big moment in the history of Reddit, which was founded in 2005. And that big day, of course, occurring at the New York Stock Exchange. Let's get right to Reddit co-founder and CEO Steve Huffman. Steve, good to see you here. Congrats on this big IPO.
Hey, Brian. Thank you so much.
I'm hearing indications might be between 42 to 46. The IPO priced at about $34. What do you? Are you surprised by that?
You know, honestly, the price is the last thing on my mind. We've been on this journey together for years with our team, with our community. And today's a day. That's what I told the team, is it's just a day. Obviously, it's not just a day, but it's certainly it's an exciting moment. But you know, we're building this for the long term.
So I want to focus in on the co-founder aspect of your title. 2005. Who is Steve Huffman today, the leader, compared to 2005?
Oh my goodness. I mean, when we started Reddit, I was 21. I had just graduated from school. Building something like Reddit to be in this moment was not even on my radar. Like we were a couple of kids building a platform because it was fun, living in the moment. And so to be here today is really, literally a dream come true and a real honor.
How is your life going to change now that you're a public company CEO?
Well, I'm having another kid in a month.
Congrats.
So honestly, like today's a day, and then on to the next adventure. But look, life is full of adventures. I think we never know what's in front of us, and so I'm just here to take it all in.
You've been out on the road show, past 2 weeks, but there was a lot of preparation even before the last 2 weeks. But within the past 2 weeks, what have you heard from institutional investors?
You know, this process, people warned me about the roadshow. I actually really enjoyed it. I've met so many great investors, and look, I love talking about Reddit, and I love seeing for folks when the light bulb goes off and they start to get it. And so I've had a lot of that in the last couple of weeks, and so I think we put together a good team.
Has it been difficult for investors to get it?
You know, Reddit is unique and special, right? It's so deep. And so one of the things I did over the last couple of years with investors is I actually showed Reddit. I did a lot of demoing. My thinking is like, we want our users to be investors, but we want our investors to be users as well. And so I think sometimes we just have to, I can only talk so much, so just showing it off is the best way to go.
Did you get pushed, that Google deal, we talked a little bit off camera, that's a big win for Reddit. Are institutional investors pushing you to make more deals with big cap tech companies to help feed their large language models?
I'd say investors, I wouldn't frame it as pushing. I think they're very interested in where this company can go. And so we've got our ads business today in the core of Reddit. Think of that as chapter 1. And then I think of chapters 2 and 3 as the user economy and then what we're doing on the data side. You know, on the data side, we've got almost 2 decades of human conversation about anything and everything. And so in an AI world where everything is increasingly written by AIs, the human-generated content actually becomes more valuable over time. And so we're starting to see that the best response to artificial intelligence is actual intelligence.
Should investors view Reddit as an AI play?
I think they should look at Reddit as a community platform that has many paths to success. So the ads, the user economy, data, there's, I think, so many things we can do, and so we're pursuing all of them.
There's been a lot of focus on the losses, 90 million.8 losses last year, net loss basis, but you actually had some profits in the back half of the year. Is this a full year of profits for the company?
Yeah, so exactly. In the second half of last year, we were profitable on an adjusted EBITDA basis. We grew costs slower than revenue last year, revenue 3 times as fast. And so I like the trend that we're on. And I think if we can keep doing that, we're in great shape.
What gets you to sustainable profits?
Look, the work that we're doing right now. I think our work is working. Reddit, we have such high margins that if we just continue to sell and we continue to be mindful about costs, this company scales, I think, in a really impressive way.
I think, of course, retail investors are heavily invested in this. You allocate a large percentage of stock to them. What's your message to those Reddit investors that have picked up stock today?
Look, I'd say thank you. You built Reddit. One of the things I think is special about Reddit is our users have this incredible deep sense of ownership. I mean, they did create Reddit after all. And so part of our purpose of doing all of this is so that our users can not just feel like owners, but have the potential to be owners. And so for those who invested, I'm really happy to have them on the ride with us.
I caught some of the conversations in this morning on various channels. Are you concerned, and I think you mentioned this in the S1, that this retail investor base adds unnecessary risk to the stock price?
Look, we want investors who love Reddit. I've heard that story, and of course, we have to enumerate all of the potential risks in our prospectus. But that's Reddit. Right? Reddit is people, Reddit is communities. We're nothing without our users. And if our users can be investors and vice versa, I think that there's nothing more Reddit than that.
Real quickly, you left and then came back to the company in 2015, right?
That's right.
How much longer do you see yourself running Reddit?
I've got my dream job. And I know it's my dream job because I had a taste of the world outside of Reddit. So I feel so profoundly grateful to have had a second chance at this. I mean, most people don't get a chance like this at all, and I've had it twice. And so I just feel this deep sense of gratitude, and there's so much more we want to do with Reddit. So,
well, congratulations and good luck on dad life. You're going to be a busy guy over the next year, Steve Huffman.
Thank you.
Appreciate
Thank you,
it.
Brian.
All right, Rochelle, back to you.
All right, excellent stuff. A big thank you there to Reddit co-founder and CEO Steve Huffman, and to our very own executive editor Brian Sozzi for that interview. All right, well, turning our eyes to the Federal Reserve, maintaining its forecast of 3 interest rate cuts this year. Central bank officials also working out how to slow the shrinking of the Fed's balance sheet. Fed Chair Jerome Powell saying he expects it will be appropriate to start that slowdown, quote, fairly soon. Well, former Federal Reserve Bank of Kansas City CEO and President Esther George joining us now to discuss this. Thank you so much for joining us this morning. So first, want to get your takeaways here, especially on that QT timing and the pace of that roll-off. What do you think that signals here?
Well, a couple of things, Rochelle. Obviously, the focus on the balance sheet has been there for some time. Remember, it has been a couple of years at the start of the tightening cycle when the Federal Reserve signaled its intention to significantly reduce that balance sheet and undertook what has been a really historic, aggressive runoff of that to the tune of $95 billion a month. I think always in the back of their mind that they would have to begin to slow that because remember, they don't want to run into the situation that happened in 2019 when the demand for reserves was uncertain. We hit that point and caused some market dysfunction, if you will. So they're being very attentive to making sure that they can continue to fulfill that commitment to reduce the balance sheet, but to do it in a way that doesn't cause disruption in the markets.
And of course, we didn't hear exactly about the timing of that first rate cut, widely expected to be June, still not off the table at the moment. But as we push closer and closer then, as we head into that election cycle at the end of the year, does that risk then causing some of this disruption that the Fed is trying to avoid?
So I think the Fed has been quite consistent on their messaging to this point, which is we are headed to 2%. We do see an opportunity in terms of confidence in the general direction of the economy and the path of inflation that it would give them the opportunity to cut rates. But I think as you heard this week, the chairman is not putting a pin on that, if you will. He is really just sticking to the narrative of we want to continue to build that confidence. We want to see that inflation beginning to come back to target. So I think the date certainly is not any more certain than it was before in terms of when they'd start that rate cutting cycle.
And he did note that the goal is to get inflation down over time and, essentially not in a rush, sort of taking a wait and see approach and seemed to somewhat downplay the recent inflation data that we saw with CPI and PPI as well. Was that expected that he was just going to really stay neutral here as they look at really a longer time frame for this inflation picture?
I think they want to be very careful. They don't want to unsettle where things are right now. I think the markets have come back into better alignment with the idea of when these rate cuts will be coming than they were a few months ago. And so I think for the Fed, maintaining a consistent message. I think you heard the chairman refer to those as bumps in terms of the inflation data popping up, looking a little more sticky. That is true for today. I'm sure they're going to be watching carefully to make sure that continues to make the progress they're hoping for over the next 2 months. But as you can see from their dot plot, they have extended out. They have shown that they will be a little more patient in getting to that 2%. and not try to risk weakening the economy and risking a recession.
And talk about some of the stickier parts of the inflation picture that you're still waiting to see perhaps a more meaningful decline in.
Well, as you know, Rochelle, we've seen the goods part of inflation, those things that we buy and set up in our homes coming down. Housing has proven to be a little stickier than originally thought. And of course, services inflation continues to be quite strong. So I think for the Fed, being able to look broadly at those inflation measures and see that it's coming down in general. Right now, it looks pretty uneven in terms of where the disinflation is coming. So I suspect that's one of the things they'll want to see is this services inflation beginning to cool more. And that should contribute to their confidence that they're going to get back to that 2% target.
And just very quickly, Chair Powell did say that a strong labor market in and of itself is not a reason to be worried about inflation. Does that suggest not necessarily a changing of some of the targets here, but perhaps a different way of looking at it?
Yeah, I heard that too. I think the idea that the labor market has stayed so strong in the face of these higher interest rates suggests that supply side effects, more people coming into that workforce, has been a positive. And that, of course, has not contributed to the inflationary dynamics. It would not be contributing to wage inflation. And so I think in that sense, to the extent you are seeing supply of labor come in, might not cause concerns about inflation. On the other hand, I think they also left open the door to saying we will be watching that labor market because it is still relatively tight.
Well, markets at least rallying on all the dovishness of what they heard and sort of shying away from some of the caution that they heard as well. Appreciate you taking the time to join us this morning. Kansas City Federal Reserve CEO and President Esther George, thank you so much. All right, well, not too many surprises from the Federal Reserve at Wednesday's meeting, but the FOMC holding rates steady once again and maintaining its forecast to cut rates 3 times this year. The central bank working hard to bring inflation back down to its 2% target. With the central bank working hard to bring it down to that 2% target, investors are still trying to navigate this sticky backdrop. For more on how to successfully invest and protect your portfolio ahead of the Fed's rate cuts, I'm joined by Anthony Saccaro, Providence Financial and Insurance Services President. Thank you for your time this morning here. So we heard from the Fed, staying the course here, didn't change the dot plot here, although moving it out somewhat here. If you're an investor and you're seeing this and you're seeing the market reaction here, how should you play this right now?
So what we tend to focus on with our clients is focusing on investments that are going to pay income. We're not out of the woods yet. And I think that's what investors are starting to believe, that maybe we're out of the woods at this point. The inflation is under control. It's started to slow, although it's had a couple of upticks. All the economic data looks great. The Federal Reserve is still targeted to lower several times this year, although that's not as much as they were planning at the beginning of the year. The market's still looking to that. But that could turn. If the economic data turns and starts to go downward, then the Federal Reserve is going to lower rates. But if the data stays strong, there's nothing that says that they're going to lower rates. As a matter of fact, they could tick up another time. I don't think that's going to happen, but it's not out of the woods. But right now, I think you want to be cautious, and I think you want to focus on things that are going to give you dividends and income, because that is the bird in the hand. If you're younger, keep dollar cost averaging in equities. If you've got 10 or more years, that's still going to play out. If you're older, you may want to caution up a little bit, take some chips off the table, and focus on things that are going to give you income, so that as you're taking withdrawals from your portfolio, you're not having to sell shares to do it. You're getting it from interest and dividends. I think those are 2 good timeframes and strategies to consider.
So, Anthony, then for those who are perhaps preparing to retire, obviously a bit of a precarious position, they're sort of in this wait and see mode. How should they approach this?
Well, we're in a very interesting time with regards to those about to retire. You know, traditional wisdom says that you want to start to decrease your aggressiveness, decrease your level of risk, decrease your holdings of stock as you approach retirement. Well, In the past, that means shifting to bonds or bond-like instruments, things that are going to pay some kind of a yield. And if we were having this conversation 2 or 3 years ago, well, the fact is interest rates were much lower at that point, yields were much lower at that point, and all of a sudden we'd be going from a stock market where we've had some good growth over the last decade to now lower yields, and that wasn't attractive. But as interest rates have gone up, what's happened is it's driven the price of fixed income investments down and the yields up. So for the first time in like 4 decades, investors that are approaching retirement can buy fixed income investments at a decreased price and get 2 benefits: locking in a higher yield, which is certainly competitive and for the longer run, and buying something at a discount. So when the Federal Reserve lowers rates, they might even be able to get some growth on that at the time that they need it. So it's potentially a good time to go back to a 60-40 portfolio, or maybe even the other way around for people going to retire, because bonds and fixed income can be used potentially today as a capital appreciation play over the next couple of years. So it's a good time for fixed income.
And Anthony, obviously a lot of people, watching the equity rally, watching the major indices closing at highs again yesterday, it could be tempting to sort of jump on this as you're continuing to see the market climb. What are 3 things people should keep in mind when they see this rally, or they see, obviously Apple under pressure today, tempted to buy the dip? How should they approach this?
Yeah, so you don't want to make decisions emotionally when you are investing. No good decisions happen when you are reacting. What you need to do is you need to have a plan in place, and that plan needs to be something that is built on some foundation that makes sense. You need to know, you need to be able to put yourself in a position to win no matter what. I don't like it when investors are in a situation, whether they're retired or not retired, that they can only win if the market does well. If you are considering, if you're in retirement, for example, we have conversations with people all the time that want to take income out of their portfolio, and they're selling shares to do it. They're cannibalizing their principal. The fact is that if they're invested in fixed income, then they can live off the interest and dividends. And if you're invested right for that stage of life, those interest and dividends are going to come in no matter who's president, no matter what wars are going on, no matter what the stock market does. Those are going to wind up coming in, period. And you can count on those. So the fact is that you want to be able to invest so that no matter what happens, you win. And I think that's an important consideration.
Indeed, important not to make those temporary decisions there on reflex action. Appreciate you joining us as always. Anthony Soccaro, Providence Financial and Insurance Services President. Thank you so much. We'll be right back on Yahoo Finance. The Department of Justice accusing Apple of violating antitrust laws by blocking its rivals from accessing both hardware and software features on its iPhone devices. Now, this is the culmination of a 5-year probe into one of the world's most valuable technology companies. Here's what Attorney General Merrick Garland had to say just moments ago.
Monopolies like Apple's threaten the free and fair markets upon which our economy is based. They stifle innovation. They hurt producers and workers, and they increase costs for consumers. If left unchallenged, Apple will only continue to strengthen its smartphone monopoly.
Well, for more on this, Yahoo Finance tech editor Dan Howley is here with more. So, Dan, give us your big takeaways here. What do we know?
Yeah, Rochelle, I think the main thing that you would look at here is how broad the scope of this suit is. It really seems to go after virtually every part of Apple's business related to the iPhone and App Store. They specifically call out Apple allegedly blocking access to things like digital wallets' ability to use the tap-to-pay feature. So that would be if a third-party wallet developer wanted to go ahead and give you the ability to not only use their app, but then go up to a payment terminal at your local store, you wouldn't be able to tap to pay. You would only be able to do that with Apple's wallet. And so they go after Apple for that. They talk about how the Apple Watch is only compatible with the iPhone rather than Android devices, and how Apple makes it more difficult for users of third-party watches, those that are not the Apple Watch, to use them on the iPhone by limiting functionality. It also calls out the App Store and how it controls that and the App Store fees that it offers. It further calls out the Apple limiting the use of super apps, so-called individual apps that let you control multiple different smaller apps within them, something that Elon Musk is trying to create with X. They also refer to things like cloud gaming. Microsoft has been heavy on Apple with this, where they want to get their Xbox cloud gaming app onto the iPhone and iPad, but haven't been able to. So they force users to go to a website instead of an actual app, which would make it easier. So it really seems as though they're going after a broad number of things with regards to the iPhone itself. And in fact, Merrick Garland talks about in a release the issue with the green and blue bubbles when it comes to messaging, saying that Apple is basically doing that itself and making users less secure when they speak between iPhone users and Android users, and that they can change that on their own if they wanted to. So, I think the main thing to look at is the potential impact that this could have on some of Apple's key businesses. That includes services through the App Store, that includes wearables through the Apple Watch, and then obviously the iPhone, because if they're forced to make these changes, it may make Android phones more appealing to other users. Now, that all depends, right? There's the status symbol that the iPhone stands for a lot of consumers. There's also, since so many consumers are now used to it, the comfortability that people have with iPhone. So they may stick around because of that. There's also just the idea that you've already purchased so many goods that go along with the iPhone and seem to work better with it, which the lawsuit is basically calling out. That could be a reason why you may want to stick with Apple. But if there are options out there that look more attractive after this suit, then people may start to try those out, test the waters with Android devices, maybe Android smartwatches. Maybe that means different app stores that they're able to access. So it could be a big change. And just on the App Store front, really quick, this is already changing in the EU as a result of the Digital Markets Act. There's going to be third-party app stores on iOS and Android, by the way. And Epic Games said that they're going to release their own app store on iOS and Android in that region. So it's not something that isn't unheard of, obviously, within the EU. How long it takes, if it ever takes place in the US, we'll just have to wait and see.
Indeed, but clearly Apple in the eye there of regulators on both sides there. Appreciate you breaking that down for us, our very own Dan Howley. All right, shifting gears now. Yahoo Finance's Pras Subramanian is standing by with Craig Keys, Infinity America's Group Vice President. Take it away, Pras.
Thanks, Rochelle. So, Craig, big day for Infinity. Last night in New York City, you guys revealed the new QX80, the flagship SUV $100,000 car here, competing against a number of big players in space. Tell me about this new vehicle and why you think Infinity is kind of set up here for success.
Thank you, Praz. It absolutely was an amazing evening. We launched the all-new 2025 QX80 on the edge at Hudson Yards, 100 stories up. So as we talk about literally elevating luxury, we also elevated the QX80, 1,100 feet above the street. I think the technology, the design, and also the hospitality embedded in the vehicle is what's going to ultimately set us apart from the competition. You mentioned a six-figure price. The starting price is actually $82,450, so very, very competitive. And the average transaction price in that segment is about $116,000. So I think we're placed extremely well. And again, if I go back to the three pillars that I center around, the design, the drive, and also the hospitality, the technology I think will speak for itself, and clients will see the attractiveness of this launch.
So Infinity operates in the luxury space, like you mentioned. We're talking about Lexus, Cadillac, the Mercedes, and BMWs of the world. Infinity sales actually up nearly 40% last year, which I found surprising in that competitive space. What do you think is driving A, Infinity sort of success, but also B, the luxury space in general?
Thanks for saying that. We were very proud of our accomplishment last year with that 40% growth. We launched about 2 years ago a QX60 in the E-SUV segment, and that's been about 50% of our sales.
What does it mean, E-SUV?
E-SUV is a large SUV, and ultimately it's a three-row, six-passenger SUV. And where I was going is that momentum is what really drove the sales improvement year over year. This year, we're looking to tack on another 10% growth, and we're going to do it focused in the FSUV segment with QX80. This is going to be a very, very exciting period for us and our retailers.
I think people are also kind of watching the product portfolio, what's next for Infinity, and you mentioned obviously the QX80, but also electrification, the first EV coming out. You guys took your time with that electrification strategy. What's behind that, and what's going to happen with the new EV that's coming out, hopefully in the next, I guess, a year or so?
So we did take our time with that, and I think back in October, you remember at the Japan Mobility Show, we had confirmed 4 models, 2 of them to be electrified. And I think we're in a good place as Infinity because you can see the speed of adoption in terms of an electrified powertrain evolution, whether it's hybrid or full EV, is dynamic. And in fact, it's slowed down a bit on the EV side, and it's accelerated on the hybrid side. And so I think it gives Infinity an opportunity to assess the landscape as we also bring costs down. And the other thing I would point to is the customer experience. We're very centered on our clients from the inception of the company in 1989. We've always wanted to be much more than just the product. And so we center around the client experience. And recently, with the cold spells that we've had around the country, we saw some challenges with EVs, and I want to make sure that we have time to, again, assess the landscape, do all the right things, so the client experience remains as high as it is today.
So real quick, last question here. We saw the U.S. government sort of changing a lot of the strategies in terms of how they want to affect EV adoption in the U.S. via, tailpipe emissions and things like that. That also means that licensed vehicles will be around for a bit longer, and hybrids potentially. What's the hybrid strategy for Infinity? Is that a viable sort of area for you guys for growth?
We don't speculate on future product, but what I will tell you is that we're always going to assess what's happening in the industry. Now, we've confirmed that essentially 40% of our lineup will be electrified by 2030, which includes the 2 EVs. But I think as client demands change, any company would be smart to make sure they keep the finger on the pulse of what's happening in the marketplace.
Pulse in the market, also talking to dealers down at the dealer level, see what's going on with the electrification in the cars there. Craig, congratulations on the QX80. Thanks so much for joining us. Craig Keyes, Vice President of Infinity Americas Group. Back over to you, Rochelle.
All right, thank you so much. Our very own Praz Subramanian. I've got my eye on that truck. Let me save my coins to get that sensory version that's that 102K, but we'll see. Thank you both. All right, well, Reddit making its debut on the New York Stock Exchange today. Shares priced at $34. It's indicated to open even above that, between $44 and $48 per share. Now, we spoke to Reddit CEO Steve Huffman earlier in the hour about the next chapters for the company.
Ads business today and the core of Reddit, think of that as chapter 1. And then I think of chapters 2 and 3 as the user economy and then what we're doing on the data side. On the data side, we've got almost 2 decades of human conversation about anything and everything. And so in an AI world where everything is increasingly written by AIs, the human-generated content actually becomes more valuable over time. And so we're starting to see that the best response to artificial intelligence is actual intelligence.
Well, the social media's IPO might be the bellwether for even more IPO activity this year. To break down what this stock debut might signal, we have Jay Ritter, University of Florida finance professor and IPO expert. Thank you for joining us this morning. So as we heard here, that the path ahead with this pure play in Reddit as a social media company, their ads business, the user economy, and of course data and all things AI as well. How do you think Reddit is set up with this IPO?
I think the company is in great shape. The company continues to grow. Investors, both retail and especially institutional investors, like to see growth, especially for technology companies where you've got certain fixed costs. Reddit's got a very high gross margin, so it can become very profitable as it grows revenue.
And of course, they mentioned their affinity program there. The CEO saying he wants, users to be investors, investors to be users. Do we get the sense, though, that the investors who are interested in Reddit are the users? Because there was a bit of back and forth online among Reddit users saying, that they didn't want to go ahead and get some of these IPO shares.
Well, there's differences of opinion among Reddit users. Some of them are going to be buying the stock and holding it. And others will be focusing on short-term patterns, trying to move the stock around, up or down. But institutional investors are going to be the important players. And they're looking at the company's future profitability, the potential there. Just like yesterday, when another tech company went public, Astera Labs, a computer hardware company, and got really positive reception. Today, it's trading at close to double the offer price yesterday. So I think both the positive reaction that Reddit is getting from institutional investors and the very positive reception that Astera Labs got yesterday and is continuing to get are really good indicators that institutional investors are very interested in a lot of the tech companies that are in the pipeline.
So, Jay, what do you think is going to make or break some of the success of the IPOs that are still to come this year? And what are some of the ones on your radar?
Fintech companies, Chime and Plaid, Wayfair Technologies, Rubrik, a cybersecurity company, are among those that are reported to be planning on doing an IPO this year. Given that the stock market is hitting record highs again today, and the positive reception to these IPOs, I think we're going to see a continuing strong recovery of the IPO market this year.
And we'll certainly continue to track all that action. Appreciate you joining us this morning, Jay Ritter, University of Florida finance professor and IPO expert. Thank you for your time today. All right, well, that's it for now. I'm Rochelle Akufo. Do stay with us on Yahoo Finance as we leave you heading into the noon hour looking at green across the board.